think it's about 60,000 a month. So 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time. And they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up and you expect new claims to go up. It really haven't much. So it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know, but it's, it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. What we saw, for example, what we saw at the end of the, the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record. Yeah,
so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks, Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what and it's, I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right, that was Mr. J. Powell for the December FOMC meeting that we have all been waiting for. Thank you, everybody, for being here. I've got Neil, who's joining me to break down what happened with the Fed. Also, we will be transitioning right into the market close in about 30 minutes. We will have Adobe and Oracle, so we got a lot to talk about in terms of those earnings, and then I believe we'll be listening to Oracle's earnings call at 5 p.m. Eastern. Neil, I'll just give you the floor. What was your raw takeaway from that meeting?
I mean, I think it's the first time in a long time that I've heard a dovish Powell. I think it's fair to say. It's been quite, I mean, less bearish and negative, and quite more positive on AI, job creation, the economy, growth. Strange. maybe he felt the pressure. I don't know. Would be strange for him to crack 6 months before he's anyways out of the job. So I guess even with the missing data, because we didn't get the data because of the government shutdown, and next week we should be getting more data, he seems comfortable saying what he just said. I mean, a 25 basis point cut was a given, let's be honest. Whoever made money on Polymarket or Calcia from a month ago when this thing was 50-50, congrats, easy money. But yeah, I mean, dovish Jerome Powell, I did not have this on my bingo card today, that's for sure.
Yeah, this was one of the most dovish FOMCs that we've had, I think, all year. And the consensus view was that it was not going to be dovish. The consensus view was that this one was going to be a hawkish cut. And I mean, I guess you can say it was hawkish from the perspective of they aren't really guaranteeing a rate cut next year. They're saying maybe one cut in 2027. But folks, if you missed some of the key quotes, there's two major quotes that as soon as he said this, I mean, we were going up, we were going down, we were going up, when we were going down. The next 30 minutes is really going to define how the market thinks of it. 3:30 to 4 p.m. Eastern is when we really see what the market thinks. As soon as he said this, which is a bit of a summary, but essentially the gist of what he said is inflation is coming in lower and tariffs may not be running the economy hot. That's when we saw the S&P make a move. We got all the way up to 688.50, which is very close to 689.70, which is our all-time high. Obviously, a lot of us are saying, can we break that all-time high? Right now, we're at 688. And then after that, he said, if we didn't have tariffs, inflation would be in the low twos, which is part of the Fed's target, 2%. And then he said, but we think tariffs are a one-time thing. So he said, hey, tariffs are the issue, which is why we've had so much inflation. Without tariffs, we wouldn't have any of this inflation concern. But we also think tariffs are not running the economy hot. We think tariffs are not going to be the biggest thing. Essentially, he said tariffs are transitory without saying they're transitory. And that's when the market really got excited, because if he's right about that, or at least the perception is that the Fed is not assuming that tariffs are going to be as big of a deal going into 2026, and you've got the labor market continuing to weaken, they can say we're only going to cut once in 2026, but it's kind of obvious they're not going to cut only once. And I think the market is pricing that in right now, and that's why we're getting some of this momentum. Neil, any thoughts on what he said about inflation and I guess how that relates to tariffs in the labor market?
I mean, the last time they said transitory, didn't work out for them. This time, I mean, I guess tariffs for now, if we go back to what was mentioned back in April, or maybe March and April, so far they have not destroyed the economy. Inflation has not soared to 5, 6, 7, 8%. So far, I guess, so good. It's not as bad as expected. Could get much better in 2026 as we lap these, let's say, difficult periods. Tariffs or the effects of it are probably going to go away, because even today we are not at the same rates as before. They've been adjusted down. Still waiting for some deal with China. I don't know when that's supposed to happen, but I guess it will happen eventually on a broader deal. But I don't know. I was quite surprised with some of the questions of people saying, "Oh, now you are paying more attention to the job market. Why are you paying less attention to inflation?" I was like, guys, are you seriously talking about why he's paying more attention to, one, also the housing market, which has been crushed for the last couple of years, and two, making sure that people are having the option to get a job or not get laid off, and still focus on inflation, but maybe a little bit less. I was like, what kind of a stupid question is that? Didn't make much sense to me.
No, I agree. And we're going to hear from Jeffrey Gundlach in a minute, who, again, has been kind of ringing the bell about how the bond market is going to have a very big issue next year. I think even he would have to admit that inflation, at least from the perspective of Powell, is not as aggressive as an issue as the market might have been pricing in going into this print. I think a lot of people thought Powell was going to say, look, we gave you the cut today. Next year, we have concerns around inflation. That's why, there was all this hesitation in November. I mean, literally in November, NVIDIA was up $500 billion in market cap after earnings, came right back down based on Fed talk, based on not the Fed chair, not the person who's very close to the Fed chair, like John Williams in the New York Fed, but just a random Fed president from Cleveland saying that she thinks maybe inflation is an issue. And Nvidia fell 500 billion market cap in one. I mean, so you had all this Fed talk in November creating fears about inflation, which begged the question for us on this show to do a lot more research about the labor market versus inflation. And based on what we just heard over the past 40 minutes, it's almost like Jay Powell doesn't really have that many concerns about inflation, which would be, I think, a 180 going into the end of the year. You talk about a perfect setup for a Santa Claus rally. That's it. If we don't get the Santa Claus rally after that, then it is what it is. But you could not have asked Powell to be friendlier to the bulls in that FOMC by being as dovish as possible on the concept of inflation not being a concern. And I think that's why we're getting some momentum right here. Robinhood at 137, Bitcoin almost at 94. We did touch it for a little bit. Ethereum 3,400, BMNR. It has been very volatile for a lot of us that got into this name, based around the 40 to 50 range. Took you all the way back down to 24. And now we're right back at 41.5. So not too bad. That's up 5.7%. Rocket Lab, a lot of talk about data centers in space. That's up 8.9% of the day. Grab goes green.
Can we talk
Nvidia's
about
still-
the data center in space thing?
Yeah, let's talk about it. And NVIDIA still can't go green, even though if we're building data centers in space, we're going to need some NVIDIA GPUs. So what are your thoughts on that entire idea?
No, I mean, it's crazy how fast these things, we first heard about it, I think Jose talked about it a month or so ago when they sent H100s to space. But there was also that podcast with Gavin Baker, I think, on O'Shaughnessy's podcast. And he talks about the fact that energy, okay, you're closer to the sun, so you get energy, but he talks especially about the cooling aspect, the fact that on Earth, all of these servers, right, they're built so they can cool the GPUs much faster, air-cooled, liquid-cooled, and in space, well, it's freezing in space, so it's much easier. But I did some LLM digging here, not digging in books. I just asked some questions because it did not make that much sense. Because you're in a vacuum in space. And so it should be more difficult to cool things down in space. There is no air in space. And so what are you going to do? Apparently, the only way to shed heat in space is via thermal radiation, infrared light. And this apparently is extremely slow and inefficient. So you're telling me that on Earth we're doing liquid cooling, air cooling, which apparently is very efficient compared to what other alternatives there are. But in space, which you are in a vacuum, so you don't have air that you can blow into these GPUs. And if you are still going to use liquid, then what's the point here? So there might be a lot of hype right now with data centers in space. I'm pretty sure it's going to happen anyways, but I think it's also one of the reasons why a lot of these small neo-cloud players are down a lot today. The CoreWeave, the Analyst, etc.
I didn't even think of that. Of course, if there's data, I mean, it's such absurd. If there's data centers in space, then yeah, Nebius and CoreWeave don't matter. Wow, that really could be the reason.
I mean, are we going to have huge gigawatt data centers in space tomorrow? No, but the market is always like, okay, you know what? Let's dump things and then let's see if it actually makes any sense. And it doesn't make any sense because, I mean, are we going to ship data centers into rockets tomorrow or even next year or even the next 2 years? The answer to me is no. Are we going to have data centers in space in the 2030s? Yes, probably. But until the 2030s, a lot of these smaller, let's say, data center companies or neo-clouds are going to have gigawatts worth of compute running through them. So overreaction from the market, as always, in my opinion, and data center in space, I mean, okay, cool, but I don't think it's going to happen anytime soon.
Yeah, I think the other reason people are getting excited about this is because the Wall Street Journal reported that Elon is touting this as the next phase of growth for selling SpaceX stock to new investors that are trying to get in at a maybe $800, maybe $1 trillion valuation. So, I mean, Elon's tweeted multiple things over the past 24 hours about data centers in space. Sundar's tweeting about it. Maybe collectively, a lot of people are starting to recognize this could be a next growth vector. Although, as Neil says, there's probably a lot of challenges that are going to be needed to ultimately get there. Bitcoin right now, 93.5. Small caps, I think that's an all-time high. January is really good for the small caps. Yup, that is an all-time high, 256. on our small caps. S&P, she's so close, 689.70, less than $1 away to get to all-time highs. And, just even if we get there and then we fade a little lower, psychologically breaking that all-time high after the past 5 weeks we've all been through, including the November downturn, that'd be a big deal. That'd be a very big deal. And, 690 to 7,000 might be on the way if it ends up playing out. Bitcoin right there, 93.6, Ethereum at 3,400, Robinhood at 137. Microsoft still down on the day. These Mac 7 names still getting disrespected. Amazon making a little bit of a move at 232. Nvidia and Microsoft are down. Tesla, I think, got to 455. There you go, 455.95. That is green. Apple, are we at 280? We are at 279. And then Meta was down in the morning. Meta right there, 649. So Meta, Nvidia, and Microsoft not really making a move as the market is moving higher. Google is moving up at 320. Healthcare is getting a little bit of a bid. So you're seeing some of that rotation into other things, along with small caps, which are propping up the market right here as we are trying to push for that all-time high. Tesla right there at 455.80 as well. Let's get to Jeffrey Gundlach. Again, he caused a lot of, concern in November. He's been a prominent bond investor speaking about how the bond market is not healthy. Let's get his take on what he thought Jay Powell said in that meeting.
From the tips versus nominal treasury market, which is appropriate. He's right about that. That's been extremely well contained in the mid twos for quite some time. So he says he's well positioned, but he's really emphasized things like, well, maybe, inflation will tick up because of jobs, being in demand or something, but I don't expect that to happen. He went out of his way to frame inflation as less of a problem. He even went so far as to say they're making good progress on inflation if it weren't for those darn tariffs, So he's trying to carve out some real estate for himself on these things. But when he says he's well positioned, I really agree with him, because at long last, the Fed funds rate is the same as the 2-year Treasury yield. It's fascinating that the Fed has dropped rates 175 basis points beginning a year ago, September, but the 2-year Treasury rate is completely unchanged. So 175 basis point drop in Fed funds has finally gotten it back down in line with the 2-year. So I think he is well positioned, and he seems pretty clearly focused more on the employment risk of unemployment rising than he is on inflation being a problem. So I think this was sold, was kind of sold to be expected to be a hawkish cut, but I don't think it was. And when you ladle on top of the cut and the language surrounding it with the 40 billion of what some people will call QE, I mean, that's kind of interesting. We've been doing QT for a long time, and all of a sudden, out of the blue, we've ramped up QE, which is probably giving people some hope that there's going to be QE if needed, and I suspect that is going to be the case. One thing that's fascinating is that people keep talking about the Fed cutting rates to help housing. Well, the Fed cutting rates 175 basis points has not helped housing. What's happened is that long-term interest rates have risen as the Fed has cut rates 175 basis points. The long bond, the 30-year Treasury, is up about 75 basis points since before they started cutting rates, and the 10-year Treasury rate is up as well. So I continue to believe, and this has been my thesis since they started cutting rates, and the market action seems to have corroborated my view, that the Fed cutting interest rates is not going to be helpful for long-term interest rates. So today we had the Fed cut, and the curve steepened again. We're out to 230s, out to about 123, 124 basis points.
We're going to have to see how that plays out going into 2025. Obviously, there has been a mismatch in the market, which is that we have cut rates, but interest rates, mortgage rates, et cetera, haven't really declined. Neil, any thoughts on that idea that although we are being dovish, the credit market is not really cooperating, especially the 10-year, which is barely down on the day?
I'll say honestly, I'm not a bonds expert or anything like that, so I don't know. It has been doing some crazy things year to date. We've seen it go under 4, then it goes back over 4. I mean, it was under 4 what, 2-3 weeks ago? We're just under 4, and now we're back at I think this morning or yesterday was what, 4.2. So again, it's a little bit low right now. People were expecting it to spike actually after today. So it's a bit all over the place for now.
Yeah, and if you look at the Powell rate cut probabilities right now, January, I said Powell rate cut, I meant Fed rate cut, but Powell's still the Fed chair. January's at 24%, March is at 46, April's at 60, June's at 87. So you have that June cut that's being priced in, but the first 3 months of the year, market's putting a less than a 50% chance until April that we even get a rate cut. And maybe if the bond market cooperates and we get yields to come down, you get yourself set up for a very strong 2026. The way to do that is for the bond market to not be afraid of inflation. Powell did his best to frame over the past hour that inflation isn't the concern and that it's only tariffs that are causing it. But it's going to be up to the bond market to decide that going into next year. ASTS, 10% on the day. Absolutely incredible. Rocket Lab, that's up 9%. It was at 58.37. Again, a lot of these space names getting some momentum based on this data center argument. BMNR is moving. Silver's at 62. BMNR right there, 41.52. Silver, the running commodities, has been, I mean, just incredible. 61.77. Gold is up about 0.5% as well. So you're seeing a lot of that move continue to take place along with the broader stock market. Trump is live as well. He announced a couple things. Number one is this gold card and platinum card. Gold card for a processing fee and a $1 million contribution. You will receive U.S. residency in record time with the Trump gold card. With the platinum card, you have to pay $5 million. You will have the ability to spend up to 270 days in the United States without being subject to U.S. taxes on non-U.S. income. We've heard about this gold card for a while now. I think like they announced it 5 different times. I guess this is like their official big announcement. But if you got $1 million or $5 million, I guess you can come to the United States. Neil, Neil, you're going to shell out $1 million to live here now?
I need PayPal to move up.
Yes, once PayPal moves up, we'll get Neil to the States. Here's Trump live. Let's see what he's talking about here as well.
Whatever you want to call it, license. They paid nothing, and they're paying now. They're paying a fair amount. I had them at 39%, but I decided to be nice. I was nice, and I think they like us a little bit better. But the money you're talking about is enormous. Our country is a very rich country, but if we do well, the market should go up and the value of our country should go up. And if we do poorly, the market then should go down. It shouldn't be the opposite. And if we go up, we should encourage it to go up more. And those numbers, when you say, 3% of GDP or 4% of GDP, they should be much higher. So, I've wanted to say it. I do say it. I believe it. And we have to get a mindset that when a country is doing well, you don't want to kill the growth. That's what they're doing. They kill the growth. I don't know if you guys even agree with that. They kill the growth because they're so afraid of inflation. But you can have tremendous growth without inflation. Everything goes up with the growth, but that's not inflation. So I think we can do much better.
All right, that's what you got from Trump. So that is the coverage on FOMC. We'll transition here to Oracle and Adobe. But I mean, ultimately, guys, Neil and I are analyzing this stuff day in and day out. We are reading a lot of stuff, watching a lot of stuff, trying to understand what's going on. I can't see how this is bearish. Does the stock price action across the entire market have to reflect a bullish point of view? No, because the markets are the markets. They are right now, which is very nice. But like objectively, that was not a hawkish cut. There's not many statements we can go to explain that was hawkish. What was hawkish was anyone who actually bet on Jay Powell saying the word Trump. I told you guys, he doesn't like Trump. He wasn't going to say it. So he said a lot of things, but for those that wasted 15 cents thinking that he was going to say Trump or soft landing, I didn't think he would say that either. Stagflation, gold, national debt, ag, trade war, stablecoin, yield curve, recession. He didn't say the R word, consumer confidence. He didn't say any of that stuff. He did say tariff. He did say shutdown, restrictive, balance sheet, good afternoon. Dude, I think you could bet on that at 94 cents. You got paid $1. That's a 6% return on betting that he would say good afternoon. It's quite incredible. But yeah, I think what was really hawkish was the perception coming into this cut, not the actual cut or the meeting itself, which was quite incredible. Oracle, Neil, what are your thoughts? And do you think this stock can pump today?
I mean, it is now up 20% or so. I'm seeing from the lows, not obviously not today, from the lows. It should have never been. It should have never been at 340 or something like that. Anyways, I mean, we were. I think I was here as well 3 months ago when the big RPO number came out, and they said we can't even, or we are probably going to see $500 billion in RPO, etc., etc. And they gave us some revenue projections, which, okay, that will happen in the next 4 years or so. That was fine. And of course, since then, a lot of things have happened. Sam Altman didn't want to answer a specific question. Default swaps are rising for Oracle, for CoreWeave. There are lots of questions about it, this whole ecosystem. Okay, fine. Today, I think the focus should be way more on the short-term success of the business, and it will be way less on the 5-10 years roadmap that they are putting out there with their RPO. Because again, the RPO is not a contract. It's not 100% certain that they're going to recognize the whole $400 and something billion or so over the next 4 years. So the market's probably going to say, okay, you know what? You gave us revenue guidance, but what about actual profitability? Because they don't have the free cash flow for all of the projects. They have a lot of debt. So that's probably what the market is looking for, some answers with regards to that. And that might also help a lot of the other smaller players. Maybe that will move NVIDIA, because NVIDIA literally doesn't move as of right now. It's one of those names that is down to flat-ish, plus all the neoclouds. So yeah, I think revenue-wise, I think they'll beat, right? I don't think the estimates, the assumptions are that crazy. But I think the whole earnings call will just be focused on how are you actually going to achieve all of this. I mean, you gave us crazy amounts of revenue for the next 4 years, but it's going to cost you. And how do you fund all of these things? Hopefully they have an answer.
Yeah, and we'll talk about Adobe in a second. I agree. I am not taking an earnings play on this one. Let me know in the chat if anyone is. I am just worried that there's not going to be that monumental 358% revenue growth or RPO growth, and they're not going to be able to announce that massive new cloud computing contract. The reason the stock pumped to 350 in a day, which was insanity, was because Oracle said that they increased RPO by 300 billion because there was one client who ended up saying, hey, Oracle, we'll give you 300 billion. That client ended up being the worst possible client you could tell the market, especially after Mr. Sam Altman's interview, that, yeah, these guys want to give us 300 billion. It was OpenAI, and we all know OpenAI doesn't have the money. Now, maybe one day they'll have the money. Maybe they'll keep growing fast enough to get the money. But you talk about Sam Altman issuing code reds because he's afraid that ChatGPT is going to stop growing because of Gemini. Next thing you know, the 1.4 trillion in spending they committed for NVIDIA, AMD, Oracle. I mean, even NVIDIA on their earnings call explicitly said, we don't have a definitive agreement set in place with OpenAI. So the market is very well to discount Oracle, not only for the 40 billion in debt that they've issued, which is why their credit default swaps have been rising dramatically, which is normal, right? That's not necessarily bearish. It's just a hedge against that debt. But two, because they just can't trust that they're actually going to get paid that. So if Oracle doesn't have that type of number on this call, or Oracle might end up saying something more about negative free cash flow with the financing of the debt, like something that is just generally not the most exciting in the short term. Maybe it pays dividends in the future, but not right now. You know, maybe the stock tanks. Now, maybe it stays flat, but if you're buying options or something, right, you gotta get a big move on this. Google right there at 321. So we're going to see what happens with Oracle, but this is going to be a monumental earnings. I don't think it's going to have the biggest impact on the market, but because they are collateral damage from this whole OpenAI fallout that the market is having them kind of stabilize the trust in OpenAI, I think would be very important. Adobe, Neil, you actually went to Adobe's conference in LA. So congratulations on that. That was super, super awesome stuff. What are your thoughts on Adobe after the bell today?
Well, that's the complete opposite. It has zero expectations. Valuation-wise is very cheap. Again, I don't own Adobe, but I do cover it. I use their services. It's very cheap. It is actually a very profitable company. Again, we just talked about Oracle. There's no free cash flow. With Adobe, there is plenty of free cash flow, high margin business, buying back quite a lot of shares. But for them, it's, AI is going to disrupt and destroy the Adobe Creative Cloud ecosystem. today we've actually had an announcement that Adobe Photoshop, Express, and Acrobat are going to be integrated into ChatGPT. They already had a sort of ChatGPT, let's say, partnership or semi-integration with regards to imaging. But they have that with Gemini. They've had, I mean, if you go on Firefly, Adobe Firefly, you can use third-party models. It's not just Firefly models. You can use Gemini. You can reuse Runway, Black Forest, you name it. So they've been doing what they should be doing. My biggest, let's say, bear case for Adobe was, and still is, if they don't move fast enough, they will give their users reasons to leave the Adobe ecosystem towards something else. As long as they innovate and move fast and have partner models, have everything that creators need, they're not giving a reason for people to leave the Adobe ecosystem. I know some people can leave and will leave to Canva, to other free stuff, but they're making a lot of money on enterprises, huge enterprises buying Adobe subscription. Professionals will be using Adobe because that's what everybody uses in the industry. When you look at design people that study in college, in university, whatever, they use Adobe. They're not going to use a free knockoff version of whatever you can find on the internet. Everybody's using Adobe. Yes, DaVinci Resolve, I use it. It's also great. Yes, Canva is free. It's also great. Adobe Express is basically the equivalent of Canva right now, which has become much better. And again, this is something that an Adobe employee told me. He said, and this is someone that worked on Adobe Express, said when Adobe Express came out, we didn't even like that product. We said we cannot even compete with Canva, but today we can. So they were quite honest with how crappy Adobe Express was at first. So we also know that they basically reiterated guidance for this year a month ago. So they're not going to miss today. It's probably going to be a double beat, and they're probably going to buy back a lot of shares. But the questions on the call will be, okay, what about AI? I think starting next year, reporting-wise, that there are some changes that will come, again, to please Wall Street with this whole AI story. But so far, again, it's one of those companies where the stock is completely crushed, and you might say, oh, stock is down a lot, so business is doing bad. But then you open the financials and it's up and to the right. Of course, we've seen things change just like this, but so far, so good, I would say.
I'll give my thoughts on Adobe on a second. This is the update from Trump and what he said about Powell today.
Now at the Roosevelt Room over at the White House, the president is meeting with CEOs from the Technology CEO Council, including Michael Dell and other high-tech executives. He just gave his first reaction to the Fed rate cut in that meeting. He said it was too small. He said this rate cut could have at least been doubled. He was not impressed. He called the Federal Reserve Chair a stiff and said that the Fed is too focused on inflation and therefore they are killing growth by not lowering rates even more. So the first reaction there from the president in real time. I also want to flag for you, Scott, a comment that the president made. He confirmed that the U.S. government has seized an oil tanker on the coast of Venezuela. He called it a large tanker, very large, largest one ever seized. So we have confirmation of that news now from the president of the United States. He also said other things are happening. So you'll be seeing that later, and you'll be talking about that later with some other people. So we don't know exactly what the president was referring to when he talked about other things happening, potentially in the context of Venezuela, given how he expressed it. But he did confirm that the United States has seized an oil tanker. We expect to learn more about what tanker it was, on what basis it was seized, and what that means for U.S.-Venezuelan relations as well. Scott, back.
All right, so some more updates with Venezuela and Trump thinking that we should have cut by 50 bips. Do have the market getting a little bit of a red candle right here. In terms of Adobe, I am not in this. I'm probably not taking this trade. I mean, I'm not going to take this trade. We only have 8 minutes to make a decision. But I think this one probably has a better shot of going up than Oracle. And I'll probably be wrong about this as well. But I mean, Oracle's had a 30% run. Adobe is down 21% for the year. I mean, Adobe literally just needs to say anything that sounds positive. We're going into the last month of the year. You've got plenty of fund managers that really want this stock to do well. It's probably not going to go up 20%, but if it can make any level of good news around revenue growth, AI as a catalyst, buyback of shares, dividend increases, whatever they can say. I mean, they don't have a dividend. Maybe they announce a dividend. That gets the street potentially more excited. Now, granted, Oracle might have just like pure better growth, and that's what the street might care about more. but I don't know if I had to bet. I think maybe Adobe pumps and Oracle stays flat. Hopefully they both end up getting a pump today. S&P 500 right there, 688. We are not touching 690. We did touch it on SPX. So we did touch 690, 6,900 on the actual index. On SPY, we're at 687.80. A little bit of a red candle in the last 5 minutes. I think we all are still pretty grateful for the move that we saw today, definitely from the dovish tone from Powell. But then again, markets are going to react violently up and down, and so far it's at least relatively strong on the day. Vatsla, thank you for the super chat, taking the Oracle trade. Wish me the best. Wishing you the best. Neil, if you had to pick between one or the other, which one do you think pumps? Which one do you think dumps?
I mean, I'd probably go with, pump. I guess even a 5% move for Adobe is good, is big enough. But if you look at the chart, it does exactly what Salesforce did. Exactly the same as Salesforce reported last week, and we've seen it go up a little bit, and Adobe actually went up with Salesforce. It's exactly the same U-shaped type of move. I mean, I hope both of them go up because Oracle, if Oracle is, let's say, bad, then all of our AI investments are going to go down with it tonight. But I think Adobe has just an easier setup, in my opinion, right now. You muted?
Oops. I put in the chat, there's 4 possibilities. Oracle up, Adobe dump, Adobe up, Oracle dump, and both pump. So we'll see. I think we covered pretty much every single category there. I don't know. If I had to bet, maybe Adobe pumps, Oracle dumps. If I really had to bet, I think more likely it's Adobe pumps, Oracle's flat. Could I see both pumping? Yes, because Adobe is still down for the year and Oracle is still down from 350. I just don't know if that's the best way to gauge it because maybe Oracle should have never been at 350. So both flat is a cop-out. You gotta have some skin in the game. If you say both is flat, then it doesn't really make it that exciting. So we're gonna see. All right, we got 5 minutes until this market closes, and then we will get some results on what we've got with Oracle and Adobe. Let's finish up with Gunlock right here, and then we'll get into these earnings in the next couple minutes.
Took a little jab at Trump by blaming what inflation progress has failed to materialize is because of the tariffs. I think he said it 2 or 3 times. So if you jab Trump, he's going to jab you back and call you stiff and everything else because that's just the way he's wired. So not surprising that Trump wants a bigger rate cut. And that just means that we're going to get more rate cuts. That just doubly reinforces what I've been talking about. We're going to get rate cuts after Powell's gone, and it's going to weaken the dollar. I just think this is crystal clear. It's already been materializing. The dollar's already down. It's one of the worst years for the dollar in the last 25 years. And I think that the rate cuts are going to weaken the dollar further. And investors should think about that seriously because it's already happening in real time. This year has been absolutely following that playbook, and Trump is telling you through that outburst that rates are coming down in the second half of this year.
And whatever Fed chair he picks likely is going to influence that decision. Let's go back to Trump right here, 3 minutes, and then we will get into earnings.
I don't know why. It doesn't make sense. Usually I can figure things out, but I don't know why, but that seems to be. But other than that, we should win because we're doing great. The economy is roaring. I think the economy is only going to go, better with all this money pouring in. We have factories being built. And forget about AI. We have AI more than anybody. We're leading AI by a lot. But we have many car companies coming in from Canada, from Mexico. They're closing up. They're coming in from Mexico. They're coming in from Canada, from Japan, from Europe, all over Europe, Germany, all over Europe. We're doing great. But for whatever reason, it doesn't matter how well they're doing, good and bad. The bad you understand, but even when a president is doing well, they seem to not do well in the midterms. So we're going to try and change it. There should be no reason for it. If anybody at the table can figure out, Bruce, a nice psychological reason, but so I want to win. and winning the midterms is important. People want us to win the midterms, and I think we have great spirit. We should win the midterms.
All right, last 2 minutes. You're seeing a little bit of red right here. This is what happens on FOMC day. A lot of the price action can be very deceiving. It usually never follows through until the very end. S&P still, though, yes, it's not 690, but 687. We haven't seen that in over a month. So it's nice to see that on the close in about 2 minutes if we still get 687 up 0.5% of the day. Tesla down from 455 to 452. Amazon still holding on to 231. Meta's been flat all day. Google still holding 320. Again, Google, the fact that it's normalized the 300s over the past couple of weeks is pretty incredible. Open Door getting hit even with the rate cut. You know, a lot of people thought the Open Door thesis was rate cuts, and that's not necessarily helping it, at least today. Netflix, wow. Low of days. We have not seen these levels since April, folks. The April lows on Netflix were 82. We're at 92. We have not seen 92 since mid-April. The absolute lows of Liberation Day for Netflix were 82. So Street's not liking this one for Netflix. I don't know why Oscar's down 8%. I don't think Trump said anything about healthcare today.
I think it's because the market awaits a vote on whether or not maybe they might or might not extend the enhanced subsidies, because apparently there's a vote happening maybe this week, maybe next week. And apparently there is a plan that has been proposed. So we'll see. We'll see what the market thinks.
All right, FOMC, December 2025. Thank you, everybody, for being here. Wednesday, December 10th, the stock market is now closed. All right, we are done for the day. And now we get two earnings from two companies that really, really matter, Oracle and Adobe, in the next 5 minutes. I think Oracle tends to be very quick. Adobe, I think, is a little bit later at 4:10, but we should get their numbers very soon. BMR closes above 40 for the first time in a month. S&P 500 at 687. Netflix, one of its worst days in the past couple of months, down about 4%. Oscar down 8%. ASTS up 8%. Rocket Lab up 7%. Can't be too upset about that. Eli Lilly up 1%. Google up 1%. Meta flat. Amazon up 1.2. Tesla's up 1.4. Palantir up 3.3. IWM all-time highs 254, closed just underneath that all-time high, up 1.37%. Grab went green, up 0.5%. Nvidia could not make a move, but that was also flat. Bitcoin 93.5 to 92.5, so you had about $1,000 candle to the downside, and then Ethereum 34.50 to 33.60 as that one came down, but still up from much higher from 3 weeks ago or 2 weeks ago at that 27.50 level. And then Robinhood right there at 135, TSM at 310, Uber down off some great statistics from Waymo today, and then Microsoft down 2.78% on the day. So we will be streaming Oracle's earnings at 5 p.m. Eastern. So we'll be listening to Oracle, and we should be getting the results in the next probably couple minutes. And we're going to see what they say. Elon has not responded to the SpaceX evaluation and IPO launch in 2026. However, some of the reporting about Elon pitching data centers in space as a new part of SpaceX's business is making me think maybe the IPO is on the table, because he's, trying to create a narrative that can, you got to sell a story when you go public, right? If you're going to buy a $1.5 trillion company going public, your upside has to be like 3 trillion, right? And you assume like, okay, one day it'll double, maybe over the next decade. There's got to be a story, and maybe it's that data center story for everybody else. Oh, yes, we have Synopsys as well. We do have Synopsys, which just got an NVIDIA investment for $2 billion. Neil, do you know anything about this company, or you guys are two peas in a pod?
Just that it is in design, and I haven't studied the business much, to be honest. But it did get a hit the last time they reported, I think, because they said that one of their clients, which was again then leaked, let's say that it was Intel, but then the stock did see a rebound because Intel got that investment from the US government plus then Nvidia. And so now that they have that money, I guess Synopsys is less scared that Intel is not going to use them that much anymore. So that's why you're seeing that little recovery there after the huge drop 3 months ago. But other than that, nada.
Yeah, I don't know too much about them, but Jensen did give them some attention as per their latest partnership. In terms of what the street wants to see at about 4:05, so in 2 minutes we'll get these numbers. So for Oracle, street wants 16.1 billion in revenue, 164 of EPS. Remember, last quarter they didn't even really beat earnings or revenue. I think they might have beat by like a very slight amount. It was that RPO number that blew everybody away. So the initial reaction might not take into account the underlying numbers outside of EPS and revenue. And so we're going to have to see what that turns out to be. For Adobe, street wants 6.1 billion in revenue and 540 of EPS. And then for Synopsys, street wants 288 of EPS and then 2.24 billion of revenue. Oh, we're getting some
In the meantime, what are your thoughts on this whole Netflix drama, succession
I was just about to say,
that's going on?
Trump apparently said Warner Bros. Deal must include the sale of CNN. That's hilarious. Dude, for everyone thinking that Netflix was just going to have an easy time, I mean, Steve was on the show on Friday and he really made a big deal of this idea around CNN and Trump. I mean, who's going to buy CNN? Netflix is not buying CNN. Their offer was to spin it out into something else, right? Here's the clip right here, and then we'll get the earnings from Trump saying that.
Get the people that have run CNN into the ground, by the way. Nobody watches, very few people watch. I don't think they should be entrusted with running CNN any longer. So I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue. I think CNN should be sold along with everything else.
All right, we're going to see how that story ends up playing out. Oracle, do we have some numbers? Synopsys is up 2%, Oracle up 2.4. Now it's up 1, now it's barely up. Oh, it's going to be pretty volatile. It's going green and red super quick. It got up to 230. Oh, now it's down. Now she's down. Now she's dumping. Down 2.7. Adobe's up 2.5. Oracle's down 2.6. Wow, 231 to 216. That could easily get right back up there. But this is a little bit more of a prolonged red candle. If that doesn't reverse, that was a major
it is
whiplash.
Out, by the way. Go on the earnings correspondent guy on X.
Okay, I'll get it. Oracle now down 4%. Wow. Gave bulls a little bit of hope. Maybe that changes and it reverses. But right now, she's getting hit. Oracle numbers, we have a miss. Slight miss. Missed by 1% on revenue, 16.05 versus 16.19. EPS, though, 40% beat. Why is the street upset? Down 6%. They beat 226 EPS versus 164. What is the street mad about? That's a massive beat for a company of their size. Adobe beat by 2% and then beat by 1%. So Adobe, relatively small beats on the top and the bottom, 550 versus 540, 6.19 versus 6.11, EPS up 14% year over year, revenue up 10% year over year. Adobe's up 2%. Oracle taking down the S&P with it. Wow, 6% on a $630 billion company. NVIDIA's probably going down as well. NVIDIA's down 0.5% on this. Oracle down 6%. And then Adobe is up 3%. Adobe is up 3%. Adobe's pumping, Oracle's dumping. That is what we've got right here. Let's get into the Oracle numbers. Let's see if we can get some coverage on this, and then we'll go deeper. That's a big move down. I mean, I thought it would be weak. I didn't think it would be 6% down week. I thought it would be 2-3%. Market would then move on. But she's getting hit. Adobe, though, loving it. That's up almost 4%. Oracle now almost 7%. This thing was at 185 last week. So, I mean, it's not like we haven't seen this before, but it's an ugly reaction. Oracle revenue up 14%. Cloud was at $8 billion. RPO is at $523 billion. I think that's similar to the last quarter on their remaining performance obligations. It might be a little bit higher, but if it's higher, then it's not higher enough to get this to move. Nebius and Iren also getting hit. Iren is down 2%. Nebius down 2. Okay, so Oracle again, cloud computing data centers. She's taken down the other data center names with her. Bitmine also down 1.6. Might be affecting the broader market. Adobe holding on to a 2.5% move, but Oracle right here down 6.5%. I'm trying to pull up their actual press release.
What did you say the RPO number was?
December. No, this is from last month. This is from the last quarter. All right, so we're still waiting for that one to be updated. But Oracle's down. Synopsys is up. Let me get Synopsys's numbers. They had a beat by 1%, 290 versus 288 on EPS, and then revenue 2.25 versus 2.24. They beat by 1%. Beat by 1% on the top and the bottom. Synopsys up slightly right now. Yeah, net income 6.6 billion versus 4.76 billion. Dude, they did almost 2 billion more than expected in net income. Down 7% on that is a little aggressive, I feel. RPO is up 100 billion. That is correct. RPO went from 423 to 523. So RPO is up, which is good. The bigger question is, why is RPO up? And
I sent you the link in the chat.
Oh, you got it? Okay, thank you, Neil. Neil, any raw reaction to this? And then we'll go through some of these numbers as well.
I mean, I'm seeing RPO $523 billion, but last time was a bit less. Well, not a bit less. Last time was 455, so a bit less than 100 billion extra. But they told us that it's going to be just above $500 billion. So okay, that's up 438%. Congratulations, which is crazy. But remember, I said they talked a lot about revenue, and I wanted to hear more about earnings. And we have a small miss in revenue, but a huge beat in earnings, and the stock is still down. So quite confused with the move. But then again, they'll have a lot of explaining to do during the earnings call with regards to, I mean, this growing RPO number and the huge part of it coming from a company that does not have the revenue to support all of these future plans. So we'll see. We can see a reversal, of course, after hours. But it is a company that is growing still quite rapidly. I mean, cloud revenue is up nicely. Infrastructure is up 68%. Of course, the dollar amount is still quite small compared to the RPO number that you're seeing there. I mean, we're talking here about 8 billion in cloud revenue, 4 billion in cloud infrastructure. But we are going into quarters and years where they should be generating a hell of a lot more every single quarter.
Oracle down 5.6. Adobe goes red. She was up 4. Now she's basically flat. She was just down almost 2% for a second. Let's get some more coverage on Oracle, and then we'll get into Adobe as well.
Figure versus the $1.64 adjusted estimate, but revenue coming in slightly below expectations at $16.1 billion, likely due to a weakness in software revenue, which again just came in slightly light. If we look at AI and cloud, the remaining performance obligations, which is the key bookings number, up $523 billion in the second quarter, up 438%. That is a higher growth rate than the previous quarter and above street estimates. Cloud infrastructure seeing gains of 68% year over year, stock down about 5.6%. We have comments here from CTO and Chairman Larry Ellison, how the company is selling Ampere because we no longer, he says, think it is strategic for us to continue designing, manufacturing, and using our own chips in our cloud data centers. He adds that we are now committed to a policy of chip neutrality, where we work closely with all our CPU and GPU suppliers. Of course, we will continue to buy the latest GPUs from NVIDIA, but we need to be prepared and able to deploy whatever chips our customers want to buy. There are going to be a lot of changes, he says, in AI technology. I would perhaps look at shares of NVIDIA to see if they're responding, but some interesting comments here from Ellison. I don't see any specific comments on financing, which of course is a big topic of discussion around Oracle, the funding of its massive data center build out, but I imagine that will be a big topic when the earnings call starts at 5 p.m. Eastern. Analysts asking for more transparency on whether this company will continue to lean into the debt market or use other tools, Morgan and John, like vendor financing, equity, or bringing in a sovereign wealth investor. Again, shares of Oracle now down 6% in overtime.
Okay, Seema Modi, and we know you.
All right, so I guess the concerns around the debt market are still the issue. CEO or CFO of Oracle said remaining performance obligation increased by 68 billion, up 15% to 523 billion. Oracle is very good at building and running high performance and cost efficient data centers, said the CEO. For years, Oracle has been investing in AI and building autonomous cloud software. Oracle's autonomous database and autonomous Linux have been key to reducing human labor. Yeah, they're just talking their book right here about why AI is important for their business. But realistically, the street cares about the financing going into how they're getting this growth. Also, I mean, 68 billion in RPO, that's a pretty massive number. 15%, not year over year, but Q over Q. Highlighted by new commitments from Meta, NVIDIA, and others. That others is definitely something the street's going to care about. Who are those others? Because, yeah, Meta and NVIDIA can definitely spend some money. And it's not really, street doesn't love when NVIDIA is the one that's spending the money on their customer. So who exactly is fueling RPO? Adobe. All right, Adobe goes flat. Let's get into Adobe numbers. Neil, any raw reaction to these numbers? I'll pull up on their website, but anything you're seeing on Adobe?
On Adobe, no, I'm still reading the Oracle stuff and comparing to what we had 3 months ago. Because 3 months ago, they talked a lot more about the revenue for Oracle Cloud Infrastructure, $18 billion for the fiscal year, then increase it to $32 billion, $73 billion, and $114 billion over the subsequent 4 years. And right now, we're not really getting any update on those numbers. So I guess that's also one of the things that they might touch on during the earnings call that is not present in this press release at the moment. And yeah, I guess, again, the question is going to be on this whole financing thing right now for Oracle, because it's still, yes, it's cool. Your RPO is growing like crazy, but 4 years from now is...
Who cares? I mean, the street's really wondering who cares and how can you justify the debt you're spending to get that RPO growth? All right, Adobe.
Actually, in overtime, the company reporting earnings of $5.50 a share, beat of 11 cents a share. Revenues of more than $6 billion, also topping estimates. First quarter guidance topping the estimate as well. Company says remaining performance obligations, a measure of backlog, stands at more than $22 billion. The CEO, Shantanu Narayan, crediting strong adoption of AI tools.
Well, shares of Oracle moving lower in overtime.
Okay, real quick before we do Adobe, I forgot, and Oracle's starting to reverse a little bit. It was down 7, now it's down 6. Folks, we have, is this correct? We have Hood. We have monthly metrics for Hood for November. Are we getting those today? I believe we're getting those today. I don't have it yet on my screen. We should be getting in a second, but that is also going to be pretty big today. I don't have it on the website yet. Should be getting in a second, but yes, December 10th, today is the day we should be getting it in a second. Here is the Adobe press release. CEO says, our record fiscal year 2025 results reflect our growing importance in the global AI ecosystem by advancing our innovative and generative agentic platforms. We are excited to target double-digit ARR growth. The company's been growing around 8%, so it looks like they're targeting 10%. 6.1 billion, cash flow 3.6 billion, RPO 22 billion. They bought back 7.2 million shares. Digital media segment 4.26 billion, total customer group subscription revenue 5.96 billion on the day. Adobe achieved revenue of 23 billion for the year, 11% year-over-year growth, 10 billion in cash flow, and they bought 30 million shares. The fact that the stock's down 25% for the year and they bought 30 million shares is quite incredible. Revenue, they're targeting 25 to 26 billion. This year, they did just under that, about 10% under that. So again, they're targeting about 23.7 billion, 7.35 billion in business professionals, and earnings per share, they're targeting around $18.10. I think that's a little bit higher than expected, not massive. And I think that's also why the street is not that excited about these Adobe numbers right now. Although you did have a bit of a pump initially. Oracle still down 4. It was down 7, hit 206, now down to 213. Synopsys, I guess that's the story of the day. 520, up 10%. 520, up 10%. They beat barely on the top and the bottom. Streets like in something that they said. Again, they just had a big partnership with NVIDIA. NVIDIA just invested $2 billion. GAAP net income was $448 million. That's up a lot year over year. Synopsys team delivered a solid finish of the year that refined our company and the leader in engineering systems from silicon to everything else. We enter fiscal year 2026 with an intense focus on delivering sustainable growth and margin expansion through continued innovation. We finished the year with a record revenue and a strong backlog of $11 billion, which underscores the resilience of our business. We are expected to drive another year of efficiency in 2026. All right, so I guess Synopsys being the winner was not on the poll choices, but that's the one that ended up winning right here. Synopsys up 10%. Planet Labs, Jose, do you know much about this company or no?
I don't know. You want to call
Jose,
Jose
why don't I
again?
call you
Or,
Jose? Dude, I just see you as Jose because when I watch your streams in the background, I just think you got Neil. What do you think about Planet Labs? If you have any thoughts on this one.
no thoughts on it. I've seen it pop up a couple of times in chat and in my comment section, but no comment. I'm purely Rocket Lab, and that's good enough for me.
Okay, so guys, let me know what this company does. They're a space company. They beat by 100% on EPS. That's relatively strong. Not profitable, but they're not losing money. 81 million, beat by 13% of revenue. Revenue's up 30% year over year. EPS is up 100%. And so that's why Planet Labs is up. Dude, I thought they sold weed, but that's Planet 13, right?
Yeah.
I was about to say, how much weed did they sell? But yeah, that's not it. Satellite imaging. Okay. Well, I mean, it's a great time to be a space company, especially over the past couple of days. Okay, Hood, let's see real quick what we've got. All right, here we go. November net deposits were $7 billion. That's up 25%. Total platform assets, 325. That's down from 333. Funded customers, 26.9 million. That's down. They probably got rid of, 280,000 dead accounts through a sheetment, which I learned about for the first time a couple months ago, but that's when a company is required to get rid of the dead accounts. Options were 193 million. That's up 24% year over year, but down from October. Crypto was 28.6 billion, down 12%, down 19% year over year. Okay, so crypto's down. Not the best. Events contracts, we already knew 3 billion. Margin 16.8 billion. That's up 2% quarter over quarter or month over month, up 140% year over year. Cash 32.5 billion. That's down 5%, but up 23% year over year. And then security lending revenue, only 34 million. That's down 40% month over month, even though it's up 48% year over year. Yeah, I would call that mixed. I would call that mixed for Hoodie. Decent metrics, but not like October. October was lights out. Now, granted, November was a really ugly month for a lot of people, given the market took a 5% hit. So it makes sense that you're seeing, but you can see right there, October 267 to 193. Not bearish by any sense of the imagination, just not living up to October, which, maybe means the street's going to react potentially negative towards that. But still a pretty strong month for Hoodie. It's because people are moving to Webull. You could point to a lot of reasons why Hood didn't have the best November. The most obvious one is when the market goes down, every brokerage takes a hit. I don't think it's that reason. I don't think it's because people are leaving everything to Webull. Adobe, Jose, thoughts on this? Does this deserve to be flat, or do you think this deserves 4 or 5%?
This is the third strike for tonight. My name is Neil. Nice to meet you.
Dude, what is going on? I don't know what is happening. I just... Neil, what do you think about it? Now I'm going to have to say it, because now I got to lean into it because it's funny. But should Adobe be up or no?
I mean, it's not like my name is not written right here in blue, but...
Oh my gosh.
Now look, I mean, I'm looking at the numbers. The numbers look fine. They even talked a little bit more about AI-influenced ARR revenue as they did actually last quarter. And it's now, they say here, total new AI-influenced ARR now exceeds 1/3 of the overall business as we deeply integrate AI deeply into our solutions. And as they've shared before, their strategy is to drive the entire book of business with AI-influenced solutions. Again, it's just just to please Wall Street. If I'm being honest, just the same type of money just being marketed as AI influenced type of money. But look, it's record cash flow from operations, record RPO for this quarter. So it's up and to the right for this company. It's already very cheap. I don't know how much is the stock down right now on these numbers on a double beat.
About half.
Probably not that much, but
No.
so yeah, I don't know. Again, it's all about the call. More comments on the whole business, on AI, on some partnerships as well. But I mean, the business is doing well. They're extremely profitable. So it's the same here as a PayPal. They just buy back an insane amount of shares, and if it continues like this again in 10 years, maybe Adobe is also a privately held company at this rate.
Yeah. The problem with Adobe here is like, this was a good quarter, as you said, records across the board. It's just, again, we talk a lot about these narratives with these stocks. What is the narrative that's super, super, super excited around Adobe? And maybe the street is looking for that. This thing got to 362, guys, before it reversed. Oracle got to 203. Oracle back down to 208, or sorry, got to 206. Almost right back down to the lows, down 6.5. Street is just not buying it at these levels. And also, it's kind of hard to buy the dip right here because, again, you don't know what they're going to say on the call. And if they end up saying something a bit more bearish on the debt financing at these levels. You know, ironically, I was just texting Jose before Neil came on and we were talking about something. So now you have to call me Tanner. That's how we...
You did indeed text me before.
No, I was texting you too, but Jose separately I was texting as well.
Yeah.
So Jose almost made it to the stream, but he had some stuff to do with his kids. So. Okay, so then Adobe is a nothing burger, flat on the day. Planet Labs and Synopsys, these two take the show, and then Oracle takes a dump. That is what we got.
For now. An hour from now, both can be green or both can be down even more. I guess we don't know what they'll say during the earnings call, but I agree with you with Oracle right now. I don't see why anyone would touch it until the call is over, because it's too risky because you don't know what the street doesn't like. I mean, we just went over the numbers. Not like they're horrible, and it's not like this stock is at $300 anymore. But yeah, I don't know. Plus the comment on Webull and Robinhood. I mean, Webull reported, I think, 2 weeks or so ago. They are growing, but I don't think many Robinhood people went to Webull. I think a lot of Tesla holders actually went to Robinhood more recently. Webull does apparently. I mean, you just use Webull. The thing is that people use it for free and they don't really monetize their users that well. That's the main critique I think people have with. Investors have with Webull. People like the platform for what it is, but they can't seem to grow their paid users as fast as the free ones, it seems, right now.
Yeah, and again, liking their charts is just not a bull case. Like, yes, a company can have a good charting feature, which is fine, but it doesn't necessarily mean that the company is growing at a rate that is exciting or meaningful. So I think a lot of people see this at $10 and they think it's a baby Robinhood, which I get it. You know, there's plenty of companies I've thought, hey, well, this one's in the same niche. It's way cheaper technically on the share price itself and on the market cap. Maybe it'll replicate it. But it's hard because, you know, you've got to really, especially in a cyclical environment like the stock market, where, you know, you really got to fight for your revenue every single day because nothing's guaranteed, just given the market conditions. That requires innovation, and that's where I don't think Webull necessarily has a big advantage. Net deposits, $7.1 billion. Again, $202 billion for equities, $28.6 billion for crypto. All of these are down month over month, except margin. Margin actually went up, which is surprising because I'm sure people got margin called heavily in November. So the fact that this one actually got up month over month is surprising, but it's up 147% year over year, which is also what we're seeing. Here's the coverage on Trump and this CNN thing that he just mentioned as well.
The president's just been talking about the Fed, as you guys have been discussing the Fed. He confirmed that he has a meeting with Kevin Warsh. That's been sort of widely speculated about or reported. But the president also said, I sort of have a very good idea of what I'm looking for in terms of a Fed chair candidate. He says, I'm looking for somebody that will be honest with interest rates. He says, honestly, our rate should be much lower. He says he's not going to be asking the candidates to commit to lowering interest rates. He says he's going to ask them questions and he'll know what he's seeing in terms of the answer there. So it's clear that the president is putting a low interest rate threshold here on his selection of Fed chair. He is meeting with Warsh, although Hassett has been reported to be in the lead for that job. The president's saying, I sort of have a very good idea of what I'm looking for. One other note here from this meeting, guys, on the Warner Brothers sale. The president was asked about CNN and what he thinks of the prospect of CNN being either included in that transaction or not included in that transaction. The president said he thinks that no matter what happens to Warner Brothers, that CNN should be sold either to the new buyer, that is Paramount or Netflix, or should be sold to have new ownership in charge of CNN. That's because the president says he doesn't like what he sees as CNN's political bias. He doesn't like the content that he sees on CNN. He wants them to change it. He wants new ownership there.
So, Neil, as a foreigner, you don't live in the United States. Any perspective on our president? I mean, you don't have to get political here, but any perspective on our president arguing that a media network that objectively is not a big fan of him should be sold in a deal, and that might be the linchpin of making this deal happen? How do you, as a European, kind of think of that?
I mean, me personally, the news, other than, of course, finance news, I don't really care that much, because every news channel will have its angle, its agenda. It's like this. But on the one hand, nobody watches CNN, okay, because probably people don't like what they're hearing anymore. So I don't see why do we need to save it? If you suck, then you will have to go down and somebody else will replace you. To me, it's that easy. I don't see why they need saving, whether it's Netflix or anyone else. If nobody watches a certain channel, show, whatever, I mean, a show, for example, the show gets canceled and we move on. Yeah. Something else will pop up. The same should happen here, whether it's CNN or whether it's going to be Fox or CNBC or whatever. If it doesn't work out, it's because people don't want to watch. And so create something else. I guess create something else, much better. People anyways go on social media, YouTube, listen to podcasts way more than they used to go and sit at 7 p.m. or at 8 p.m. every night and listen to their favorite Ron Burgundy talk about the news and whatever. So I don't know. I mean, this whole Netflix acquisition story thing really reminds you of Succession. It's insane how accurate and close this is. But yeah, I mean,
what is your take? Who gets Warner Brothers, Netflix or Paramount?
I mean, for now they have a contract. Then they have an agreement with Netflix. Whether or not that agreement will be broken up is another story. Now, if it gets broken up because of Netflix, then it will cost them $5.8 billion or so. But if it gets broken up by Warner Brothers, then they'll have to pay $2.6 or so billion to Netflix. And I guess Paramount will be the one making the acquisition if, of course, it gets approved by regulators. But people say, look, Paramount offers Central Neil News. It's people say, Paramount is offering $30, which is more than what Netflix is offering at $27.50 or so. But Netflix is offering that only for the studios and only for streaming. And so, yes, I've heard the CEO of, what's his name, David Ellison, say that, but that other side of the business is worth only $1 per share. Yeah, okay, of course you're going to say it to convince Warner Brothers shareholders to take your deal. But to me, if I were a shareholder, one, if I want to exit, of course, I'll take the $30. Thank you very much. It's more money in my pockets. I'm out. But if I really like the business, which Warner Brothers have been doing quite well, I'd say, then I would go with Netflix, because Netflix is a much better business than Paramount today. Free cash flow wise, revenue wise, subscribers. You might not like the content. That's fine. There is enough content on the platform for everyone to like and to watch. I actually love the content on Paramount. Taylor Sheridan, great shows, Yellowstone and all of that. But I do think that Netflix combined with Warner Brothers Studios and HBO makes a hell of a lot more sense. And I don't buy this counter argument that, oh, Netflix is going to destroy theatrical releases. They literally said a couple of times that they're not going to kill theatrical releases. What I do think that again, my personal opinion, what is killing cinema is, one, bad movies, very bad movies. Two, super expensive cinema tickets, super expensive popcorn and drinks. I mean, imagine you go out to watch one movie for 2-3 hours. If you go out with friends and family, you're probably already paying $50, $60 or so just for one night. Or you can stay at home, watch a movie on Netflix, and that costs you $18 per month for the whole family. And so if people don't go to cinemas anymore, it's probably because it became super expensive and the movies suck. Okay, I used to go a lot more to the movies. Today, I'm only going for a Christopher Nolan movie, or maybe now Avatar, and yeah, maybe some big Marvel movies or whatnot. But other than that, even the Oscars, I used to be very excited about the Oscars because, that they're going to, this actor might win it, this movie might win it. Now, for the last 10 years, I have no idea what type of movies won the best movies out there. It's always the weirdest one that let's face it, a lot of it is political, a lot of it is inclusion, culture, whatever. And maybe that's why people just don't want to go watch movies anymore, because they used to go watch movies for escapism because it's great, it's cool, space exploration or the Wild West or cowboys or mafia movies. And today it's more of the same. It's like, it's gender or it's color and it's this and this identity, and like people are like, ugh, leave me alone. Yes, on Netflix you also have cultural bullshit shows, fine, but you have the choice not to watch it. It's like nobody's forcing you to click on that movie. If I don't like a show, I'm like putting the thumb down and it goes away on my feed, and I only have good shows on the feed. So I don't own Netflix, but if I would, I'd probably be buying today, yeah, if I would like to own it.
Well, so you would take advantage of this dip if you like, or would you personally be compelled, like at 85, at 80? Like, is there a price where you think Netflix is a premium asset that deserves your capital?
Today, if I would be looking to buy, I would probably buy it today. Again, I'm keeping my cash for some other things that might or might not happen. But if I would be buying or looking to buy, I would definitely be buying it today. It's trading at close to 30 times forward PE, but it is still expected to grow above 20% this fiscal year, the next one, and the one after that, above 20% earnings growth. And free cash flow is also expected to grow faster than that in the upcoming 2 fiscal year, of course, excluding any acquisition. Advertising business for them is expected to grow quite rapidly next year and the years after that. It is a very well-run business. That's just a fact, which just became much cheaper than before. If they do buy Warner Brothers, I do think they'll become an even bigger business in the future. And if not, then a competitor is going to get those very, very lucrative IPs, because I mean, Harry Potter, Game of Thrones, DC, and etc. is worth a lot of money. Is worth a hell of a lot of money. Whether or not it goes on Netflix because they own it or through licensing is another story.
Yeah, I agree with you. I mean, the biggest concern I've had about Netflix for so many years was that I thought tension was shifting away from traditional sort of linear television and sitting on your couch to people just listening to a podcast, or people using that form of escapism that they had at the movies with content creators that they enjoyed listening to. So that is sort of a macro bear case for Netflix, but nonetheless, it is still a premium asset that if they do acquire Harry Potter and all these amazing brands. By the way, I know who Ron Burgundy is, okay? Everyone's saying I don't know who that is. is in Star Wars. All right. So I don't know why you guys are acting like I don't know who this guy is. But now some of the other references Neil made, I have no freaking clue what he was talking about. But I trust that Neil knows what he's talking about. The point is, like, I think that they need content, because a lot of times the Netflix studio content, it's not good. Like, some of the stuff is good. Like, you get a hit like Squid Game, which they ruined season 2 and season 3. Like, I cannot believe they let that show decline in quality, and I don't even think that's a contrarian take. It was just season 2 and season 3 were horrible. And then Stranger Things, but like for every Stranger Things or Squid Games, you get a lot of crappy shows. And the beautiful thing about HBO Max is they have such high quality IP that ultimately that IP will outweigh a lot of the losers that they end up having.
Yeah, and I mean, you heard the comment from the Paramount CEO say, yeah, we're going to release 30 theatrical releases if this acquisition goes through. I'm like, we don't need 30 theatrical releases. We need quality content, which is something that Apple has been doing extremely well. Apple is not releasing like 100 TV shows and movies every single year. No, but the ones that they do release is very good. HBO, same thing. They release quality content. That they've been releasing quality content for decades and decades. I don't need 30 theatrical releases, 30 movies coming out each and every year. Something that Marvel also, they did very well for 15 years, I'd say 10, 12 years or so. And then Disney like exaggerated with their releases every single month, another TV show that came out. I'm like, guys, my God. And it hurt them because there was superhero fatigue. There was just fatigue, period, because I mean, we couldn't keep up anymore with these types of content. So that is not a good argument. To me, the monopoly argument is not a good one at all, because
Agreed.
Netflix is not a monopoly. Even with this deal, they're not even close to being a monopoly. YouTube is leading the way by far and growing very, very rapidly. Plus, Netflix doesn't have a studio. So now they'll own a studio, which again wouldn't compete with Netflix core business, might actually enhance it. And Netflix literally enhances what HBO does. HBO does already quality content, like you said. That's not the problem. The problem is the distribution, and Netflix fixes that in just one click, which is why I am all for this acquisition. I just really hope that, yes, HBO and Warner Brothers, they do still, I mean, they stay HBO and Warner Brothers, and that's about it. I think Netflix said that as well. We're not going to rebrand everything and say, oh, it's a Netflix original. No, it's going to stay Warner Brothers, and HBO is just a brand owned by Netflix, which to me is fine. And it should also help Netflix content, like you said, because quality content. I do like Stranger Things, the current season that was released. I think it's so far so good. So far so good.
Planet Labs getting a move right here, up 17%. So this one was the real winner after hours. Adobe up a little bit. Not a big move, but a little bit, 0.67. Oracle still getting hit. Synopsys up 5%. It was up a bit more. Oracle right there still down 7% at 207. We'll get the call in about 20 minutes. And then NVIDIA going down with Oracle. Going down with Oracle, not 7%, but it is down 1%. Neil, another pick that you had this year that you held on when shit looked ugly, but I think a lot of people ended up holding on with you. Micron, this one has massively outperformed a lot of the semiconductor names. Is this something you're still long on, or do you think it's time to take some profits here?
So I still own it. I am thinking, because they're yet to report. I think they report next week, Wednesday or Thursday, one of the two, I believe so. Yeah, I'm up, I think, 160% on that, and that's not even a year-old position, which is crazy. But I'm not buying here. I might, yes, maybe take some profits, because again, if we continue to go up, okay, my initial position is just going to grow more and more. But if suddenly we hit a certain roadblock, which business-wise I don't think we will, because they're firing on all cylinders, but maybe things are priced to close perfection, I would say. But you're going to need Micron, SK Hynix, Samsung. I think SK Hynix, there was some news that came out that they are looking to be listed in the United States. That could be very interesting. They're the leader in this whole memory space. But no, I mean, execution has been very good for Micron. And yeah, maybe taking profits again is not a bad thing. We're at the end of the year, so if you're looking for cash and if you want to buy something else that has been crushed, maybe if you own Micron, then maybe that's a name you wanna take profits from, and then keep the rest for the ride, because HBM for them is still going to go up like crazy. And yeah, they're fully focused on this growth in AI, and the memory cycle this time is going to go much higher, and it's going to last much longer than the previous memory cycle in phones and PCs and whatnot, which was my original bull case at the start. I didn't understand why the market hated this one, when it was very clear to me that the current upcycle is just going to be a huge one for them. And whenever we'll hit the end, I guess we'll have signs from the big tech players and the semiconductors that, okay, demand is slowing down, but so far, so good.
Yeah, Josh Wolf from Lux Capital, also super bullish Micron, and they've been long for a while. And his thesis same as yours. If you're gonna have an AI revolution, you're gonna have to have you're gonna have to have some level of memory in order to make that revolution make sense in a meaningful way. Got an update right here from Waymo. I mean, they had some amazing miles driven today. Take a look at this. A baby was born inside a Waymo during a ride to a hospital in San Francisco. That is quite incredible.
Okay, so the question now is, does that baby get free unlimited Waymo rides for life? Because that's usually what you should be getting when you are born on a plane. Although I don't know if it's happening that much these days, but that was the rule. If you're born on a plane, you are flying for free.
Yeah, I mean, I think Google would get a lot of brownie points if they give the baby and their parents free Waymo forever.
An unexpected delivery inside of a Waymo. A baby born in a driverless car is bound to happen. Waymo says the pregnant woman was riding to UCSF last night when she gave birth during the ride. Remember, no driver. Waymo says its remote support team detected that they felt something unusual activity, and called to check in on the rider. They called right through the car. Then they called 911. Waymo says the car kept driving to the hospital. Mom and baby made it safe before the first responders got there. This is the second time a baby has been born inside of a Waymo. The first birth happened in Phoenix earlier this year.
That's crazy, bro. This is going to be happening more and more as robotaxis become a thing. And it's going to be part of our lives.
She could have been born in the back seat of an Uber driver. Imagine that.
Yeah.
That would have been an experience.
Yeah, I mean, the fact that she had the privacy to even have that baby in the Waymo because there was no driver, that's definitely another big part of that entire thesis around robotaxis. We got 15 minutes until the Oracle call. Tom Lee just put out a new podcast. Have not listened to all of it, but here's a clip of his argument for Ethereum. I think, Neil, you're not the most bullish on BMNR, but you're relatively bullish on the concept of the Treasury. And we're starting to get a little bit of recovery as the Fed has now officially cut rates.
I think so. What's like your wildest price call on Ethereum? Because you've made some calls, but these are boring. $7,000, $10,000. Come on.
Yeah.
Like, what's the actual like craziest call?
Well,
it can be super long term. I'm not like.
Yeah. I mean, I just give people some framework to think about.
Yes.
Like really simple.
Yeah.
They should just have two ways to price Ethereum in their head. Okay. One is what is its price ratio to Bitcoin? That should make sense because they're like, if you think Ethereum's story is getting better than Bitcoin, like there's more excitement or things happening, then its price ratio relative to Bitcoin should go up. I mean, it's sort of like, it would be like a relative price comparison. And that price ratio in the past was like 0.08. That's the average price of Ethereum to Bitcoin. Well, if someone thinks Bitcoin gets to 200,000, which I think it will, then Ethereum, just to get to its long-term average, is like 16,000.
Yeah.
Okay, and it's like 3,000 right now. Now, if Ethereum gets to the same value as Bitcoin, the network value, that's like 250,000. Which could Ethereum be more valuable than Bitcoin in the future? keep in mind, OpenAI is probably, if it was a publicly traded company, would be worth $1 trillion. And it's one of 4 or 5 LLMs. OpenAI just by itself is worth 3 times Ethereum right now. Is Ethereum more valuable in relative to AI? Right. OpenAI is just one of like 8 models. And if Ethereum is the dominant L1, shouldn't that be worth
more than
a couple trillion?
Neil, do you agree with that general sentiment, or do you think it's reaching a little bit too much on Ethereum?
I mean, any comparison with OpenAI for me doesn't make much sense, because I don't believe that OpenAI should be trading where it's trading right now in the private market. I mean, Dan Ives spoke on CNBC, I think this morning or yesterday, and said that their valuation is conservative. I'm like, are you serious? Is it conservative? It's not conservative, but fine. You know what? Fine. Look, if it plays out, if we are going to get like a huge infrastructure refresh where everything or every asset runs on Ethereum, then I guess, yes, BMNR and Tom Lee are going to be proven right. They aren't even staking right now, right? I don't think they are staking their, so that's yet to come and to generate them quite a lot of cash. So I think people should put their expectations a bit lower. These things will take time to play out. I mean, I remember the first big presentation that he gave a couple of months ago with regards to the trillion in market, financial markets, and how that will change, and how fast, well, not how fast, the number that Ethereum could grow. What was it, 60,000? So I can't remember the exact number he put there. And I'm like, okay, but to reach that number, a lot of things need to go his way, and a lot of these things will take years and years and years time to reach those goals. 5-10 years from now, are we going to see a lot of tokenization? Probably. I mean, we're already seeing it today, but to reach $1 trillion market and refreshing the whole infrastructure there is just going to take a while. And I think expectations for a lot of investors need to be a lot lower and more realistic, I would say.
Yeah, I agree. I mean, there is a massive bull case on Ethereum from a tokenization stablecoin perspective, but the undeniable truth is that it requires a liquid environment in the context of global liquidity, which is why the rate cut stuff was good today. But you just don't get that mass appeal and that risk on sentiment if you don't have liquid ecosystem. And so we've been tightening for 3 years. I think the intersection of Wall Street and crypto is real, but you need the Fed to be on your side. And if it is in 2026, then that could be bullish. Paramount just sent out a letter, or I think Warner Brothers sent out a letter. Let's get an update right here on what's going on with this Netflix situation.
Welcome back to Overtime. We got an update on the battle for Warner Brothers Discovery. Julia Borston has that for us. Julia?
Well, we've seen a letter from Paramount Skydance, which has just gone out to Warner Brothers Discovery shareholders, urging them to accept the $30 per share tender offer. Some key notes here in this letter. The letter says, to suggest we are not good for the money or might commit fraud to try to escape our obligations, as certain reports have speculated, is absurd. They go on to say that absurdity is underscored by the fact that Warner Brothers Discovery and its advisors never picked up the phone or typed out a responsive text or email to raise any questions or concern or to seek out any clarification. They go on to say, for the avoidance of doubt, our $6 billion synergy estimate does not rely on cuts to content budgets at our studios, and they intend to continue running both separately post-close. They say those synergies will be from technology, linear networks optimization, and real estate rationalization. They also criticize Netflix's strategy when it comes to regulatory approval, saying Warner Brothers' transaction with Netflix appears to be in for a long and bumpy ride as it navigates the global regulatory review process. They say that the argument being advanced publicly by Netflix and its proxy states that regulators should ignore the streaming video on demand market and instead utilize a gerrymandered market definition that includes services like YouTube, TikTok, Instagram, and Facebook. Going on to say Netflix's claim boils down to trying to mask its dominance in streaming video on demand by grouping together all internet-enabled video media and social media or otherwise, saying no regulator has ever accepted such a broad approach to market definition, and to do so would require regulators to give up on merger enforcement in media and social media alike. quite harsh words here in this letter that Paramount Skydance is sending to Warner Brothers Discovery shareholders, urging them to tender their shares. And we will reach out to the parties for comment, especially the criticism of the regulatory potential. Back over to you.
Yeah, it's super fascinating, especially when you see shares of Paramount.
Does that scream desperation to you?
I was just about to say the exact same thing. They sound very desperate, and the argument to, I mean, the counter argument to the argument that Netflix is making here with regards to, yes, the competition is of course YouTube, it's Instagram, it's TikTok. It's not something new. It's something, if you go back to their, I think, press release of, I don't know, 2-3 years or so ago, they already said it. They said their competitors are the likes of TikTok, Fortnite. I believe they specifically mentioned Fortnite in one of their letters, because yes, you are competing with these types of companies, because these types of companies are also entertaining, and the most important part here, consume people's time in their day. You have 24 hours a day. People sleep, work, and then, or maybe don't work, I don't know, but in between those things, you might or might not watch Netflix, Instagram Reels, TikTok, play Fortnite, Call of Duty, and eventually GTA in 2046, whenever that thing comes out. So yeah, this is the desperate attempt from them. Their bid is really not that attractive, if you're asking me. Plus, if you still want to own share, your own share of a company that has quite a lot of debt anyways. But yeah, the market share argument is, I'm going with what Netflix is saying, because I also think that, I mean, Roku is saying it, I think YouTube is saying it. So what, only Paramount is not seeing that the competition is TikTok, YouTube, and all the others? Doesn't make much sense. And no, they don't have the money. So that's why they have to raise tens of billions of dollars.
Yeah, and I think Warner Brothers would rather sell to a company that they know that has the money and is good for it. Now, Larry Ellison's got a ton of money and he can backstop it, but there's a different sense of selling to an individual. I mean, essentially, you're selling it to Larry. You're not selling it to Paramount. You're selling it to Ellison because he's the one backstopping the trade. Versus Netflix has a lot of equity and a lot of assets that they're good for it. So it makes sense why they went with Netflix over Paramount. But the Trump stuff is definitely going to complicate how this actually ends up getting done. These were the top 20 options, or the top 20 stocks trading the options market today. Tesla and Nvidia again at number 1 and 2. Netflix, for the first time in a long time, getting there at number 3 with 823,000 contracts that were traded today. Then you had TSM, Palantir in the top 5, Oracle, Amazon, Warner Brothers, Microsoft, iBit, Apple, MicroStrategy, SoFi, Meta, Intel, Uber, GameStop, Opendoor, Rivian, and AMD. So these were your names that were traded the most throughout the entire day. And obviously the earnings for Oracle is probably going to increase some of that volatility. We got 4 minutes until the Oracle call. Neil, if you had to ask a question on this call, same thing to the chat. And I'll put a poll if you think Oracle reverses right here. What would be the question that you asked today?
I think it's the question is, okay, you've given us the RPO 3 months ago. You've given us sort of a roadmap on revenue recognition, but seeing how a big chunk of your RPO is coming from a certain company that does not have the financial capability to support such projects, how are you going to basically achieve all of this? No, Jose, you are muted.
Thank you. Thank you for letting me know, European Jose. I'll be Indian Jose, you're European Jose, and then the actual Jose is just Jose. We got to troll him on this next time he comes on, because he's probably not watching. He doesn't know that we did this. What I was going to say, if I was the CEO, I would say you got to glaze OpenAI, right? You got to be like, OpenAI is the best company in the world and they're growing the fastest and they need a lot of compute and cloud. And I mean, you've got to make the market believe that Oracle is going to be one of the core providers for OpenAI. So it's not like it's a hard answer, but it's a question of, does the market believe it? And Sam Altman didn't necessarily give them the most to believe in over the past couple of weeks with the code red and the way he answered some of these questions. So I think that's going to be the biggest thing. This is what the two CEOs said a couple weeks ago when they were asked about the partnership last time.
You don't think it's going to be a winner-take-all kind of a situation?
I think the market is too big. No, look, the market's too big, and I think that there's far too much kind of open space that has to be solved. Do I think that there might be winner take all in certain niches? Of course. But the reality is that AI is applicable to everything. You know, someone who's really good at optimizing for drug discovery, it may not be the same model provider that's really good at optimizing your business results. So I think there's going to be many winners. And the good thing for us in terms of mitigating any downside is that the infrastructure these customers needs, while in some ways it's customized, is largely the same. And so really, when you look at the build out that's happening across the industry, it's a bet on the success of AI. Obviously, we have a great relationship with OpenAI, but there are many different customers that are all going to need this type of infrastructure for many, many years to come.
You don't think it's going to be a winner?
I don't know if Larry Ellison's going to be on the call today. I think he was on the call last time. And so maybe we'll see him comment today. But if not, these are going to be the two CEOs that are going to be talking. And yeah, we're going to see what they end up saying. Broadcom, by the way, for those asking, is tomorrow, along with Lulu, which is tomorrow. So today is just going to be Oracle. Okay, call is not live yet. Should be live in a second. About 30 more seconds. And then we'll see what we get for Oracle. In terms of the poll, 54, about 50-50, 54% say no, we don't get a reversal. Oracle right here. Still bleeding, 7%. I mean, it touched
Adobe is
185.
flat, green flat.
Yeah, Adobe compared to Oracle. Adobe is having a great day. But yeah, I mean, maybe Oracle dips back below 200 if it gets that ugly. And also, the call for the first 30 minutes might be really boring. Actually, this is my first time legit. Like, I've listened to parts of their call before. This is my first time listening to the whole thing. So this call might have a lot of numbers that are read before we get into any question that actually affects the market. And so we're going to have to see what the street actually cares about when the call goes live. NVIDIA as well, getting hit. This one just, again, I think do you think that NVIDIA, AMD, do you think AMD is a better buy right now versus NVIDIA? Or do you think the OpenAI concern is still an issue for NVIDIA? Because I know you're way long AMD, Neil. How are you thinking of those two?
I mean, it's not like OpenAI. I mean, AMD, OpenAI they also have that relationship now, right? Because if OpenAI delivers, then they get 10% of AMD in what is it, five years or something like that. If AMD reaches $1 trillion in valuation based on the trenches that they need to meet from OpenAI, so it's not just. I'm surprised that AMD is not getting hit as much as NVIDIA more recently, but. I'm fine with that. But again, NVIDIA reported 3 weeks or so ago. Well, I mean, we were live and numbers were good. Things seem to be going their way and it's not slowing down anytime soon. So it's just purely sentiment right now and it will change. We've had that before. We've had the Blackwell heating issues / delays. Then we've had DeepSeek, and then we have China. Every month we have China issues, or even though they've told us that China is $0 right now of their business. Yes, they might send H200s to China. China might not allow it, so maybe they're sending it somewhere else. And Chinese companies I don't know what the heck's going on there. But anyways, it's $0 of their business. What was $0 before and is now becoming much bigger for them, larger, is UAE, is Saudi Arabia, is all of these other countries that are buying huge amounts of NVIDIA GPUs, and I don't think that's slowing down anytime soon. So I might not own NVIDIA, but I'm very bullish on NVIDIA. I'm, of course, very bullish on AMD, purely from upside perspective, I guess. But execution is... for both of them has been quite good. Next year is a big year for AMD because they are really coming out with a much better competing solution with the MI400 series. And funny enough, AMD has a close relationship with OpenAI and also Oracle. So we'll see.
All right, let's get into the call, and then we will keep going from there.
$0.03 positive impact on earnings in Q2. For Q3, assuming currency exchange rates remain the same as they are now, currency should have a 2 to 3% positive effect on revenue and have a 6 cents positive effect on EPS, depending on rounding. In terms of the results for Q2, we had another excellent quarter of execution. Remaining performance obligations, or RPO, ended the quarter at $523.3 billion, up 433% from last year, and up $68 billion since the end of August, driven by contracts signed with Meta, NVIDIA, and others as we continue to diversify our customer backlog. RPO, expected to be recognized in the next 12 months, grew 40% year over year, compared with 25% last quarter and 21% last year. Total cloud revenue, which includes both applications and infrastructure, was up 33% at $8 billion, representing a significant acceleration from the 24% growth rate reported last year. Cloud revenue now accounts for half of Oracle's overall revenue. Cloud infrastructure revenue was $4.1 billion, up 66%, with GPU-related revenue growing 177%. Oracle's cloud infrastructure businesses continue to grow much faster than our competitors. Cloud database services revenue was up 30%, with autonomous database revenue up 43% and multi-cloud consumption up 817%. Cloud applications revenue was $3.9 billion and up 11%. Our strategic back office applications revenue was $2.4 billion and up 16%. As we finish combining our industry-based cloud apps and our Fusion cloud apps under one selling organization in each region across the world, we have been seeing increasing cross-selling synergies that are expected to drive higher cloud applications growth rates in the future. All in, total revenues for the quarter were $16.1 billion, up 13%, and higher than the 9% growth reported in Q2 last year, continuing our trend of accelerating total revenue growth. Operating income grew 8% to $6.7 billion. Non-GAAP EPS was $2.26, up 51%, while GAAP EPS was $2.10, up 86%. We recognized a pre-tax gain of $2.7 billion in the quarter, stemming from the sale of our interest in Ampere. Turning to cash flow, operating cash flow in Q2 was $2.1 billion, while free cash flow was a negative $10 billion, and CapEx was $12 billion, reflecting the investments being made to support our accelerating growth. As a reminder, the vast majority of our CapEx investments are for revenue-generating equipment that is going into our data centers and not for land, buildings, or power that collectively are covered via leases. Oracle does not pay for these leases until the completed data centers and accompanying utilities are delivered to us. Rather, the equipment CapEx is purchased very late in the data center production cycle, allowing us to quickly convert cash spent into revenues earned as we provision cloud services to our contracted and committed customers. In terms of funding our growth, there are a variety of sources available to us.
I think that's on their side for the audio.
Throughout our debt structure in public bond, bank, and private debt markets. In addition, there are other financing options through customers that may bring their own chips to be installed in our data centers, and suppliers who may lease their chips rather than sell them. Both of these options enable Oracle to synchronize our payments with our receipts and borrow substantially less than most people are modeling. As a foundational principle, we expect and are committed to maintaining our investment grade debt rating. Turning to guidance, let me start with the impact of the added RPO that occurred in Q2 on our future results. The vast majority of these bookings relate to opportunities where we have near-term capacity available, which means we can convert the added backlog to revenue sooner. The result is we now expect $4 billion of additional revenue in FY27. Our full year FY26 revenue expectation of $67 billion remains unchanged. However, given the added RPO this quarter that can be monetized quickly starting next year, we now expect fiscal 2026 CapEx will be about $15 billion higher than we forecasted after Q1. Finally, we are confident that our customer backlog is at a healthy level and that we have the operational and financial strength to execute successfully. While we continue to experience significant and unprecedented demand for our cloud services, we will pursue further business expansion only when it meets our profitability requirements and the capital is available on favorable terms. As it relates to specific guidance for Q3, total cloud revenue is expected to grow from 37% to 41% in constant currency, and it's expected to grow from 40% to 44% in USD. Total revenues are expected to grow from 16% to 18% in constant currency, and are expected to grow from 19% to 21% in USD. Non-GAAP EPS is expected to grow between 12% to 14% and be between $1.64 and $1.68 in constant currency, and grow between 16% to 18% and be between $1.70 and $1.74 in USD. And with that, I'll turn it over to Clay.
Thank you, Doug. Our infrastructure business has grown at an accelerating 66% year over year. You are well aware of the strong demand for AI infrastructure, but multiple segments across OCI are also contributing to this accelerating growth rate, including cloud natives, dedicated regions, and multi-cloud. Our diversity of capabilities within infrastructure differentiates us from AI infrastructure neoclouds. Our unique combination of infrastructure and applications differentiates us from other hyperscalers. We have ambitious, achievable goals for capacity delivery worldwide. OCI now operates 147 live customer-facing regions with 64 more regions planned. In the last quarter, we handed over close to 400 megawatts of data center capacity to our customers. We also delivered 50% more GPU capacity this quarter than Q1. Our supercluster in Abilene, Texas is on track with more than 96,000 NVIDIA Grace Blackwell GB200s delivered. We also began delivering AMD MI355 capacity to customers this quarter. Our pace of capacity delivery continues to accelerate. We continue to see strong demand for AI infrastructure across training and inferencing. We follow a very rigorous process before accepting customer contracts. This process ensures that we have all the necessary ingredients to deliver to customer success at margins that make sense for our business. We analyze land and power for data center buildings, component supply, including GPUs, network gear, and optics, labor costs for all phases of construction and low voltage work, engineering capacity to design, build, and operate, revenue and profitability, and capital investments required. Only when all these components come together do we accept customer contracts, having the confidence we can deliver on schedule with the highest quality. As Doug said, this quarter we contracted for an additional $68 billion of RPO. These contracts will quickly add revenue and margin to our infrastructure business. We continue to carefully evaluate all future infrastructure investments, investing only when we have alignment across all necessary components to ensure profitable delivery for our customers. The holiday season is peak period for many of our retail and consumer customers. It is our responsibility at OCI to deliver the most secure, highest performance, and highest availability infrastructure to support these customers at the scale they need. Uber has now surpassed 3 million cores on OCI, powering their highest traffic ever this Halloween. Temu scaled to nearly 1 million cores for Black Friday and Cyber Monday. In addition, we also supported thousands of other customers across our retail and other applications through their largest and most successful holiday period yet. OCI is constantly expanding in features and services. We recently launched Acceleron, delivering enhanced networking to all OCI customers, and other services like our AI agent service. However, we cannot deliver everything ourselves, and we rely on our rapidly expanding partner community to provide the best experience on OCI. We added new AI models from Google, OpenAI, and xAI to ensure our customers have the latest and greatest AI capabilities. Our marketplace consumption has grown 89% year over year, powered by partners like Broadcom and Palo Alto. Those same partners drive OCI consumption by building their SaaS businesses on OCI. Palo Alto released their SASE and Prisma Access platform on OCI, and Cybereason and Newfold Digital continue to scale their businesses rapidly. These partnerships make our ecosystem richer, which helps our customers, and that growth translates directly into more OCI growth as our partners build their solutions on our infrastructure. Oracle Database Services see increasing demand across all clouds. Multi-cloud database consumption has increased 817% year over year. We launched 11 multi-cloud regions this quarter, bringing us to 45 regions live across AWS, Azure, and GCP, with 27 more planned over the next month. We see increasing customer demand with billions in identified pipeline. We launched 2 important programs this quarter for multi-cloud. The first is Multi-Cloud Universal Credits, which enables customers to commit once to Oracle Database Services and use them anywhere in any cloud with the same price and flexibility. The second is our Multi-Cloud Channel Reseller Program, which enables customers to procure Oracle Database Services through their preferred channel partners. We also launched 9 services across the different clouds, such as Oracle Autonomous AI Lakehouse. This combination of the best services, universal availability, consistent and easy pricing and procurement, and partner support is accelerating the adoption of Oracle Database Services across our entire customer base. OCI is the only full cloud available to individual customers. We launched Dedicated Region 25, which provides the full capability of OCI in a tiny 3-rack footprint. OCI is also the only cloud that enables partners to become cloud providers themselves through our Alloy program, and our new footprint is available for all Alloy providers. Dedicated region and Alloy consumption grew 69% year over year. We launched 1 dedicated region for IFCA Group in Oman, and both NTT Data and SoftBank launched 1 Alloy region each this quarter. This brings our live dedicated regions to 39, with 25 more planned. In summary, the 4 segments of our infrastructure business are growing at incredible rates. This will contribute to a continued acceleration in our infrastructure revenue in the coming quarters. Customers are choosing OCI for its performance-optimized architecture, unrelenting focus on security, consistently low and predictable pricing, and unmatched depth in database and enterprise integrations. Those priorities have been our strategy from the beginning and are the driving force behind this growth. OCI is in a constant state of reinvention, and you can see the value that has for our customers. When you combine our commitment to deliver the best in performance, efficiency, and security with the growing customer demand for cloud infrastructure services we are seeing, I couldn't be more excited about what's coming next. And with that, over to Larry.
Thank you very much, Clay. Over the years, Oracle has developed software in 3 important areas: database, applications, and the Oracle Cloud. We used AI to make our database software and our autonomous software eliminates human labor and human error, thus lowering operating costs and making our systems faster, more reliable, and more secure. Now, with the development of the Oracle AI Database and the Oracle AI Data Platform, we're bringing all 3 layers of our software stacked together to solve another very important problem: enabling the latest and most powerful AI models to do multi-step reasoning on all your private enterprise data while keeping that data private and secure. Training AI models on public data is the largest, fastest growing business in history. AI models reasoning on private data will be an even larger and more valuable business. Oracle databases contain most of the world's high-value private data. Oracle applications also hold huge amounts of exceptionally valuable private data. The Oracle Cloud includes all the top AI models, OpenAI ChatGPT, xAI Grok, Google Gemini, and Meta Llama. Oracle's new database and AI data platform, plus the latest versions of Oracle applications, enables all of those AI models to do multi-step reasoning on your database and application data while keeping that data private and secure. All our database and application customers want to do this because for the first time, they get a unified view of all of their data. AI models can respond to a single inquiry by reasoning across all your databases, all of your applications. By treating all of your data holistically, the combination of AI models plus the Oracle AI database and AI data platform breaks down the walls that isolate and fragment your data. The Oracle AI data platform makes all your data accessible to AI models, not just Oracle databases and Oracle applications, the data in Oracle databases and Oracle applications, but data from other databases, cloud storage from any cloud, even data from your own custom applications are accessible to AI models using the Oracle AI data platform. Using our AI data platform, you can unify all your data and reason on all of your data using the very latest AI models. This is the key to finally unlocking all the value in all your data. Very soon, through the lens of AI, you will be able to see everything happening in your business as it happens. Mike, over to you.
Thanks, Larry. As Doug shared, the total revenue growth up 13% in constant dollars. I think it's worth noting that that's 3 consecutive quarters now where total revenue growth has been in double digits. So a solid quarter, and we see even better days ahead of us. So let me break down a few of the numbers a bit further, and I'll do so all in constant currency. Cloud applications revenue was up 11%, and that brings us to about a $16 billion annualized run rate. Within that, Fusion ERP up 17%, Fusion SCM up 18%, Fusion HCM up 14%, NetSuite grew by 13%, Fusion CX is up 12%. In our industry clouds, specifically hospitality, construction, retail, banking, restaurants, local governments, and communications all combined, we're up 21% in the quarter. So big growth rates on a big base. In our health.
Bro, their call is having issues. It's not me. Audio probably will come back.
The stock. So is the stock.
Regulatory EHR is generally available, and it has received U.S. regulatory approval. And finally, in healthcare, in Q3, we expect both our bookings and our revenue to accelerate materially. So overall, cloud apps were up 11% on a bigger base. This is very meaningful because we see this business as continuing to accelerate going forward. We achieved this growth while we also undertook a major Salesforce reorg in many regions throughout the world. This is something we've been talking about for many years, and that is the synergies between our back office applications and our industry applications. We're seeing more and more deals where our industry apps are pulling Fusion or the Fusion apps are pulling the industry apps. And as a result of seeing more and more deals, we're also seeing larger deals with more components. So recently, we combined our industry application sales team and our Fusion sales teams into a single selling organization. This enables our sellers to have more strategic one Oracle conversations with our customers to sell higher and to sell more. And then when you think about our very large install base of on-premise application customers, these strategic conversations are driving upgrades. And you've heard us say before, just moving a customer to the cloud results in a 3 to 5x annual revenue lift compared to support revenue. Now, on top of all that, top of the Salesforce, the one Oracle go-to-market motions, the industry suites, think about combining our AI data platform with this unmatched suite of applications. This creates an incredibly unique opportunity for our customers to gain value
very quickly from enterprise-grade AI. The combination allows customers to unite the industry-leading foundational models with company-specific proprietary data, as Larry mentioned, much of which comes from the Oracle applications. And of course, the AI data platform also ties in non-Oracle applications, competitive data sources like MongoDB or Snowflake, object stores, and even complete bespoke unstructured data. So we think this allows our customers to very easily build enterprise lakehouses, AI agents, and applications that leverage built-in, not bolted on, but built-in AI to transform their business. So just to repeat, AI, of course, is a great OCI play, but it's also a broader software play for Oracle. It's driving growth in our applications and our database businesses as well. Let me highlight a few key wins. In communications, the communications industry, Digital Bridge Holdings selected ERP and SCM. Etihad Salam Telecom, SCM. Motorola Solutions, ERP, SCM, and CX. Tim Brazil, who's the country of Brazil's 5G leader, just signed a new 5-year expansion to accelerate AI adoption and to transform customer experience at scale, all built on OCI. This 5-year deal was an extension of a partnership that began with Tim Brazil's full data center migration to OCI back in 2021. So they're now building AI agents that are powering real customer interactions, including the Conta agent, which compares bills for customers across months and explains variations automatically. Already in the pilot, 18% faster issue resolution with the AI agents built on OCI. Expecting even further improvements as the rollout continues. They've got 24 projects in motion. 7 of them are already in production in just a matter of months. 6 more launching soon, all enabled by a multi-cloud architecture with Oracle as the key AI infrastructure partner. Already, as a result of this initial rollout, customer satisfaction is up 16%, and call center flows are managing end-to-end with 90% accuracy, resulting in 30% faster services times for customers and a 15% fewer network failure interventions, all using predictive analytics and again, AI copilots built in OCI. So we are the AI engine for Tim Brazil to enable personalization at national scale. In financial services, Core Civic selected ERP, SCM, and HCM. Prime Life Technologies, ERP. Jewelers Mutual Insurance, ERP. In public sector, City of Costa Mesa, ERP, SCM, HCM. The United States Space Force, ERP, and HCM. The City of Santa Ana, ERP, SCM, and HCM. In the high-tech industry, Solar Edge Technologies, ERP, and SCM. Zscaler, ERP. Dropbox, ERP, and SCM. I could go on and on about these wins, but I think it gives you the flavor of just the sheer amount of multi-pillar wins and why it's so important that we have so many different options for customers in back office and front office. In terms of go lives, we had 330 cloud apps customer go lives this quarter. That's multiple go lives per day. Virgin Atlantic Airways went live in September on Fusion ERP and HCM and payroll. Broadridge just recently relaunched their Fusion ERP and EPM go live. LifePoint Health just went live on their 3rd wave of Fusion ERP, SCM, and HCM. Saudi Telecom is live on Fusion SCM with ERP and HCM to follow soon. DocuSign is now live on Fusion Data Intelligence. Again, I could go on about the go lives with 330 of them in the quarter. Gives you a flavor of some of the really important go lives that we had recently. The cloud application deferred revenue is up 14%. That is higher than the cloud apps revenue growth of 11%. Just to reinforce my earlier statements that we expect continued apps growth acceleration. So a solid quarter across the board. We're on the back end of a sales reorg that was focused on unified selling across our applications portfolio. We're seeing a clear AI halo effect for our cloud applications, which is driving upgrades. Our AI data platform, combined with our applications, is an absolute conversation changer, and it brings the Oracle database and all of our applications into the center of the modern agentic enterprise. Looking ahead, we're executing well on a big and growing pipeline, and I expect revenue and earnings growth to accelerate off an even larger base. With that, Ken, I'll turn it back to you.
Mike, Tiffany, if you could please poll the audience for questions.
At this time, if you would like to ask a question, press star, then the number 1 on your telephone keypad. To withdraw your question, simply press star 1 again. We will pause for just a moment to compile the Q&A roster.
All
Your
right,
first
Q&A.
question comes from the line of Brad Zelnick with Deutsche Bank. Please go ahead.
Thank you. Congratulations and a particular shout out to Mahesh and the team for standing up a massive amount of capacity in this quarter. My question is for Clay or maybe Doug. Oracle is clearly the destination of choice for the most sophisticated AI customers, but this is a far more capital intensive proposition, unlike any business Oracle's ever been in before. Very specifically, how much money does Oracle need to raise to fund its AI growth plans ahead? Thank you.
Thanks for the question, Brad. This is Clay. So look, I'll answer that question in 2 parts. First, let me give you kind of the reason why it's hard to answer that question exactly. So the thing I think that a lot of people don't understand is that we actually have a lot of different options for how we go about delivering this capacity to customers. There's obviously the way that people think about it, which is we buy all the hardware up front. And as I talked about at my financial analyst meeting, we don't actually incur any expenses for these large data centers until they're actually operational. So then it goes on to, well, how do you pay and what's the kind of cash flows look like for the stuff that goes into the data center? Well, we have some other interesting models that we've been working on. One of them is that customers can actually bring their own chips. And in those models, Oracle obviously doesn't have to incur any capital expenditures up front for that model. Similarly, we have different models that we're working on with different vendors, where some vendors are actually very interested in a model where they rent their capacity rather than selling their capacity. And as you can imagine, that comes with different cash flow impacts that are favorable and reduce the overall borrowing needs and capital required for Oracle. So as you can imagine, as we look at all of these kind of commitments, we will use a range and a variety of those such that we minimize the overall cost of capital, as well as, in certain cases, we'll be raising our own funds. As part of that, I think it's important that everyone understand that we're committed to maintaining our investment grade debt rating. So now to give you some more specifics, what I would say is we've been reading a lot of analyst reports, and we've read quite a few that show an expectation of upwards of $100 billion for Oracle to go out and kind of complete these build outs. And based on what we see right now, we expect we will need less, if not substantially less, money raised than that amount to go and fund this build out. So hopefully that helps answer your question, Brad.
It does. Thank you. It's very helpful, and thanks for taking the question.
Your next question comes from the line of Ben Reitzes with Melius Research. Please go ahead.
Hey guys, thanks a lot. Appreciate it. Good to speak with you. In light of the answer to that question, the path for OCI margins seems very important to improving the EBITDA and cash flow. So at the analyst meeting, you said margins for AI workloads for OCI would be in the 30 to 40% range over the life of a customer contract. I guess my question is, how long will it take your AI margins across all your OCI data centers to ramp to that level, and what needs to happen to get there?
Yeah, thanks for the question, Ben. Look, the answer is it really depends. So the good thing is that, as I mentioned earlier, we don't actually incur any expenses for the data centers until they're actually built up and running. And then we've highly optimized the process by which we actually put capacity in and then are able to hand that over to customers, which means that the period of time where we're incurring the expenses without that kind of revenue and the gross margin profile that we talked about is really on the order of a couple of months. So in that scenario, that time period is not material. So a couple of months is not a long time. What actually matters much more is the overall mix of the data centers that we have online, right, and how they're growing compared to the total amount that we're scaling across the world. And so I think as we go through this build out phase, right now we're in a phase of very rapid build out without the majority of the capacity online, obviously the aggregate mix is going to be lower. But as we actually get the majority of this capacity online, and that's really our focus, the best way to improve margins quickly is to actually go out and deliver capacity faster. That ends up very rapidly ensuring that we get to that 30 to 40% gross margin profile for all of the AI data centers.
Thanks.
Your next question comes from the line of Tyler Radke with Citi. Please go ahead.
Yes, thank you for taking the question. And this question's for Larry or Clay. So Oracle has clearly established itself as a leading provider for AI infrastructure to AI labs and in some cases enterprise clients. How are you thinking about the opportunity to sell additional platform services such as database, middleware, other pieces of the portfolio, similar to how we saw cloud providers add that on at the early days of the public cloud space? And what might be some of the similarities or differences that you see with the emerging AI platform as a service market versus the traditional cloud platform as a service market? Thank you.
Well, let me start with traditional cloud and traditional Oracle database. I think the biggest change we've made there was to make our database available in everyone's cloud. So you can buy the Oracle database at Google or Amazon. It's available at Microsoft Azure as well as OCI. So that was the first move we made. We call it multi-cloud, and we actually embed OCI data centers within the other clouds. So they get the latest, greatest version of the Oracle database. Second thing we did is we actually converted the Oracle database or added capabilities to the Oracle database to allow you to vectorize all of your data. So it's a vector database. Some people call that an AI database. So it's designed to make data available to models. You can then, once you vectorize your data, you can place AI models on top of that, and the AI models can understand what's in the database and reason with the data that's in the database. So we think that combination of making our the data available in our database also accessible by AI models dramatically increases the value of the data. We think that's so far, none of the other large-scale databases have been able to do that. We can do that. Not only we can do that and keep your data secure. That's one of the bigger issues. We have to scale it, keep everything reliable, keep it secure, and we actually have to add all of those capabilities and features to the Oracle database. So that was step two. First, multi-cloud. Second, vectorize all the data and make it accessible by all of the popular AI models. Third step. Well, it's great that we're making the Oracle database data available to these AI models, but companies actually have data that's not stored in an Oracle database, is not stored in an Oracle application. So we built an AI lakehouse we call the AI data platform that actually points to and vectorizes all of your data, whether it's in an object store in different clouds, whether it's a bespoke application, whether it's in another database. It really will take the universe of your data, catalog that data, vectorize it, and allow an LLM to do multi-step reasoning on all of that data. Now, the thing that's really remarkable about that is think about asking one query, asking one question, and the model looks at all of your data. Normally, when you ask a question, you have to direct it to this database or this application. You can't say, look, I'd just like to know who's the next customer I should be selling to. I'm a salesperson in territory. I want to look at all the accounts in my territory, and I want to see who's the best prospect in my territory. Well, that means looking at contractual data. It means looking at publicly available data. That means looking at our sales system. at our support system, all of these separate systems. Well, suddenly all of that data is unified. We take all of your data and unify it. So you can ask a single question, and the AI models can find the answer to that question regardless of what data store it's in. That's really a unique proposition, and we think that thing is going to turbocharge the use of our database and the use of our cloud dramatically.
Thank you.
Your next question comes from the line of Brent Thiel with Jefferies and Company. Please go ahead.
Thanks. Question for Larry and Clay on the fungibility of your infrastructure. What would you have to do to convert a data center from one customer to another, such as if one of the larger customers was unable to pay?
Yeah, thanks, Brent. So I think the first thing to understand is that what we deliver for our AI infrastructure is exactly the same cloud that we deliver for all of our customers. We made specific choices at the beginning of OCI around bare metal virtualization and the way in which we do things like secure wipe of hardware, et cetera. But the reason I bring that up is that, take as an example, anyone right now with a credit card can show up and sign up for any one of those hundreds of regions that I talked about earlier, and you can spin up a bare metal computer in as quickly as a few minutes. And at the end of that, you can turn it off, and I will recycle that, and I can hand it to another customer, in less than an hour. And so when you ask the question of, well, how long does it take to transfer capacity from one customer to another? It's on the order of hours. And what actually I think is kind of a corollary to that question is well, then how long does it take customers to adopt it? And thankfully, we have a lot of experience getting more than 700 AI customers on our platform, including the vast majority of the large model providers already run on OCI. And when we give them capacity, they typically spin that capacity up in the order of 2 to 3 days. And so when I think about how long does it take for me to take capacity and hand it to another customer, it is not a laborious process. It is not a unique process. And something else I would say that I think a lot of people don't realize about our cloud is this is actually happening all the time. So, we have lots of customers that might sign up for a thousand of one type of GPU, and then they'll come back and say, well, actually, I'd like to get even more capacity somewhere else. Will you take this back? And we do that all day, every day. And we're constantly moving customers around and, adding aggregate net capacity. So we have the technology, we have a secure base from which to do that. And we also have a customer base of a lot of demand, such that whenever we find ourselves with capacity that's not being used, it very quickly gets allocated and provisioned.
Your next question comes from the line of Mark Murdler with Sanford Bernstein. Please go ahead.
Thank you very much for taking my question, and congrats on the quarter. Doug, you gave some color earlier tonight that I'd like to dig in on. Clay presented a slide at the financial analyst meeting where he showed the revenue and expenses for a single data center. Doug and Clay, can you talk about the cash flow for that same data center, starting with the commitment for the data center and then the hardware, and how that flows into becoming cash flow positive, and then how that rolls up across multiple data centers? Any color would be really appreciated.
Sure, happy to answer, Mark. So as we talked about earlier in this call, it starts with the actual data center itself and the power capacity along with it. And the way in which we structure that is that we incur no cash expenses until that's fully delivered and provisioned and fit for purpose. So then it really comes down to what does the cash flow look like for the capacity that's going inside the data center. And as I talked about earlier, that really depends on kind of the business model and the financial model that we've used for procuring that. In some cases, customers actually want to bring their own hardware, in which case we don't have any capital expense, and it's really around the data center itself, possibly some networking gear, as well as human labor costs. We have other models where vendors want to rent that capacity, in which case those rent payments start when the capacity is provisioned for the customer. And so customer cash flow comes in, We're then taking that cash flow and pushing that out to all of the different suppliers. And then obviously you've got the model where Oracle takes its own cash, pays up front for the hardware, and then puts the capacity in. That's obviously the most cash intensive up front. And then there's a depreciation schedule over the next several years. So it really depends on the exact business and financial model used for each of the data centers. And then you ask, well, how do they layer together? Well, thankfully, they're not. We don't need calculus for this one. Basic arithmetic is enough because they actually just layer on top of each other. So if you have a time schedule for one data center and a time schedule for a second data center, the cash flows add together. And obviously, if the data center comes in sooner, you'll have the expenses as well as the revenue coming in sooner. If the data center moves out, then the expenses and the revenue also move out.
That's very helpful. I appreciate it.
Your final question comes from Don DiFucci with Guggenheim Securities. Please go ahead.
Okay, I won't make you kiss my ring. It's actually John DiFucci. Anyway, I'm sorry. Listen, a lot of my questions on infrastructure have already been asked.
So what is happening
They're really
today?
important questions because that's a big part. That's your big part of your growth. But I have a question on the applications business. Mike, you said applications are going to accelerate this year. Why the confidence in this business when all your large SaaS peers are seeing just the opposite, where growth is decelerating, especially because, we thought that something similar about Oracle's application business last year. We didn't really start to see it until the fourth quarter. We've heard some things in the field around One Oracle, your go-to-market motion, where apps and infrastructure are more combined versus separate. And you also talked about combining vertical and horizontal apps teams here. Is that it? Is it mostly go-to-market? Is there something more about the products or something else that we should be thinking about? Thank you.
Well, thanks for the question, Dad. First, I think it's a combination of things, but let me just start with what I think is happening in the industry. All of our competitors are largely in the best-of-breed business because they're not in the applications business in totality. They're not in the back office business. They're not in the industry business, and they're not in everything in between. They're not in the front of the house, the back of the house, and the middle of the house. We are the only applications company in the world that's selling complete application suites. Then you add in baked-in AI, the AI halo, baked-in AI right into our application. So we're over 400 AI features live in Fusion already. I mentioned 274 customers live on our clinical AI agent. The go lives for these clinical AI agents, which are a new breed of SaaS applications for us, are measured in a matter of weeks. So you're looking at an industry like healthcare where it would take months or years to get anything done of that magnitude. Weeks. And by the way, John, the customers are implementing these things all by themselves. They don't need us to help them. You just roll them out and they work. So we're in the applications industry suite business. We're building AI into our back office applications, our front office applications, and we are building applications that are also AI agents themselves. They are in fact AI agents. That's why you see the growth rates in our industry applications of 21% in the quarter. Our Fusion ERP is up 17%, SCM up 18%, HCM up 14%, CX up 12%. Again, all on a bigger base. Then I think the next piece of this is you add in the AI data platform. So if you'd like an industry suite of applications, then you'd like to create your own AI agents. You'd like to create and unlock your own enterprise data on top of it all. We are the only all of those ingredients for a customer. And I think as you look at customers, tiring of spend on best of breed because the integration costs are so high, and it's hard to bolt AI onto all of that because you're actually not retiring anything in the process. We're in a very unique position. And I think we're starting to see it in the numbers too, John, with the deferred revenue for apps growing at 14% now, faster than the in-quarter revenue growth of 11%. For all those reasons, I'm optimistic on our apps business going forward that it's a continued growth engine for Oracle.
Thank you, Mike. As you were talking, I sort of clarified in my mind. When I think of One Oracle, I thought of it when I started to hear about it as a go-to-market motion, but it's more than that. It's actually it's a product thing too. It's everything. So thanks a lot.
Thank you.
Thank you, John. A telephonic replay of this conference call will be available for 24 hours on our investor relations.
Well, that was Oracle's call. I'll go first, and then we'll get Neil's reaction. I've never heard their call before. For those that have heard the call before, I've also never heard these many glitches in a call, these many random beeps. There is a universal sound for those that have an iPhone on when someone sends a text or receives a text. We heard that multiple times. I guess they left it on speakerphone and they were near the mic. I mean, it's fine to be texting during an earnings call, just don't have it on the speaker where thousands of investors are listening to. And then in terms of the questions and commentary, I mean, my simple takeaway was there was zero excitement from the CEOs, the co-CEOs, or Larry Ellison on what they're doing with AI. And it's very weird because RPO is up $70 billion quarter over quarter. So you would think you would get excitement, energy, enthusiasm, and just like this broader understanding of, hey, like this is our market to win and we are going to win. And I didn't get that. Stock's down 11%. You can't just say it's from the earnings itself. They beat EPS by 40%. So maybe it's a bit of an overreaction. I do think the way they answered questions maybe wasn't conducive to the street. The one good thing they said, we got a little bit of a pump to 202, was when they said we're going to be having substantially less than $100 billion that is going to be needed to finance building up the data centers. What does that mean? Is it 80 billion, 70 billion? They already issued 40 billion of debt. Will they issue another 20 billion, 60 billion? Is still substantially less than 100 billion. So I don't know. I think that call was an absolute mess, and I don't have any more clarity. And I agree with Rushil in the chat who was saying that it's almost like Oracle was discussing RAG as like some proprietary, amazing form of AI as an ecosystem for, you know, margin efficiencies and productivity. And it's like retrieval, augmented generation, that stuff has been around for a while. So it's not like that was the most exciting in the context of what's going on with AI. Neil, what were your thoughts on this entire call?
Yeah, so a couple of things. First of all, the EPS stuff. So the big beat is because of the recognition of pre-tax gains of $2.7 billion of the quarter for the sale of Ampere. So, okay.
I did not know that. That's a big deal. Okay, that's a big one.
Yeah, I mean, I was looking for that in the press release. I don't think I found it, but they basically said that at the start of this of this earnings call. Then the $100 billion stuff. I am looking at the exact thing that they're saying. They said what we see right now, we expect we will need less, if not substantially less. Okay, cool, but that doesn't confirm a lot, I would say. And then, yeah, I mean, like you said, I don't know. I had a feeling that this was more of a call you have during, I don't know, a product day or an analyst conference. Like, I don't care what you do with your Oracle apps or whatnot. This is an earnings call. Speak about numbers. Speak about how fast you expect this thing to be built out. Exactly, maybe, yeah, okay, the stock took a huge hit when they suddenly announced, suddenly it's going to be $15 billion extra in CapEx. I mean, that's quite a big increase from 3 months ago that you didn't acknowledge about it. In 3 months, the things went up by $15 billion. But okay, they said it's because they are moving faster. They could be recognizing revenue earlier because there were a couple of, I mean, the problem with these earnings calls is that a lot of the times the good questions get asked, but they don't get answered, right? Suddenly the dude, it's like Amazon, not this time, but 3 months ago. It's like asking good question, and then Andy Jassy and the other guy, it's like talking for 10 minutes on something that wasn't even asked. So again, in this case, it's more blah, 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 blah. But yes, here, expect fiscal 26 CapEx will be about $15 billion higher than we forecasted after Q1. But I guess this is because, yeah, they want to monetize RPO faster than previously expected, which, okay, fine. Throughout the earnings call, they then explained the various ways for them to recognize, and sometimes the client will come in with the chips. Sometimes they will not. Sometimes they will rent it out. Sometimes they will not. I'm like, yeah, okay, you're not telling me something new, something that the rest isn't doing, right? Nebius, say CoreWeave, it's also the same. It's like they're paying for the bare metal, and yes, they will come in with their own chips. So I don't know. I don't know.
Yeah, and I don't think this is bearish Oracle by any sense. The call was definitely bearish and the stock is reacting bearish, but I mean, it does get to a point if this thing gets anywhere near that 175, 180 range, it probably gets a bounce. But it was just not, I think, what the street wanted to hear, even though, as you said, they increased CapEx, which should be good for NVIDIA. NVIDIA's down. The street doesn't like that. Nebius and CoreWeave, all the data center plays going down because I mean, they are kind of correlated with Oracle's business model and with their business practices in terms of the debt financing. And you know, if the biggest debt issuer is not really giving you the stuff you want to hear, then CoreWeave and Iren, Nebius are going to get hit. CoreWeave down 3% after hours, Iren down 2%, and then Nebius down 2% as well. Yeah, I mean, I agree with what Neil said. Oracle, at the end of the day, is going to be a very important player in cloud computing, and the increase of CapEx, the RPO growth, all that is positive. But this call was not a call where they like, did you even hear, someone mentioned in the chat, I didn't even hear like agents or agentic workflows or like meaningful discussion around the future of enterprise workflows in the context of agents. We heard about very old concepts in AI, like RAG. And you know, Larry Ellison talking about how, you know, the data needs to be secure and confidential. It's like, dude, like we've heard this many times. Like, yes, we get it. You guys are going to protect the data. It's like, okay, what's the next step, right? Like, how do you really make this make more sense? And maybe they're getting tired of explaining it. And, you know, it's been 2.5 years and, you know, most investors kind of know how the story is playing out and you're seeing it in some of the numbers. But this was not a call to incite a lot of confidence or excitement for someone who's new to Oracle, like myself, in terms of listening to their first call ever and be like, man, this is a name that has to be in the portfolio over the next 10 years when it comes to, or at least next 10 months when it comes to AI growth. And that's probably why the stock is down 10%.
Yeah, I mean, yeah, the messaging here, again, a lot about messaging, because the numbers are there. It's either they're not sure about the upcoming 12 months, even though they are still giving us certain numbers, but it wasn't clear. It's like I was listening to an earnings call where, okay, now I'm even more confused than what I was 2 hours or an hour or so ago. The numbers are there, the RPO is there, but again, give us a little bit more. Like, oh, thank you for the added color. What added color? What added? I just got more confused by what they were saying. And by the way, they answered 2 questions the exact same way, which I also found, okay, thank you for no added color in this case. But yeah, it's more confusing than anything else. It's not bearish on the name, right? It's not like, oh, there is no revenue coming in or they're not growing. They are growing. It's just we didn't get much valuable information from them. Like if I wanted to learn more about the Oracle product, I would go and look at some of their blog posts or YouTube videos or whatnot. I would not be listening to an earnings call. I'm listening to the earnings call to hear more about the $500 billion in RPO that you are talking about and how that will, well, flow from the top to the bottom lines for you. But yeah, apparently,
Also,
I guess.
Someone asked, like, hey, what happens to your RPO if one customer can't come through? They didn't, the analysts, I think, had a little bit of respect and didn't want to say, what happens if OpenAI can't pay you? So they kind of framed it politically in a more correct way. And they didn't have an answer. They had some nonsense about how, well, we're diversifying. Yeah, it's like, no, dude, if OpenAI can't come through with the money, what happens? And I think that's when the stock took an even bigger dip. So I agree with you. I don't think they really gave any clarity. And they did not give you, I mean, if you're an AI company in this world, in this market, and you're telling us you have $500 million of RPO on the books, and then you're not getting people excited for how you're going to monetize that RPO, or sorry, $500 billion, or clarify how that $500 billion actually ends up coming to shareholders through, you know, the bottom line net income, it is a little hard to be like, all right, I'm going to be long this stock. I would rather just buy more NVIDIA.
or a CoreWeave or a Nebius, because they have been quite clear how they're going to recognize and how much they're going to recognize and how much they're going to generate 12 months from now. Yes, it's also CapEx heavy, but they explain it in a very, very simple way. It's like, okay, we are going to need this amount of money. This is the ARR exit rate for next year. This is our backlog. This is the new contract for Nebius with Microsoft and Meta. And that's it. At least we know what's going on. Here, it's, I don't know, maybe maybe Larry was too busy with the Paramount stuff. I don't know, even though it's his kid, but yeah, I don't know. It's a strange earnings call where they just seems like they woke up like 2 hours ago, like, God damn it, let's go on ChatGPT, summarize the earnings call for me quickly, and they used fast instead of thinking, and this is what we got. This is basically it.
I would agree. That earnings call did seem like it got freaking summarized by ChatGPT, because there was no nuance or excitement or just original thought, I think, that we got out of this one. In fact, the most important thing we had, which is what Neil tweeted about during the call. By the way, this is Neil's YouTube. So for those that are on my channel, if you are not subscribed to Neil, please make sure you subscribe to him. We will be collaborating in the future on some calls. Neil, do we want to do Broadcom? You can let me know. We might be able to do Broadcom tomorrow, but that will also be a big one. Yeah, we usually do pretty much all the big AI ones, including NVIDIA. This was the most important thing I think that happened. Times Person of the Year, which people have been predicting on the prediction markets for the past month now, is AI architects. So that's who you got for Person of the Year. Neil, what was your reaction to the conglomerate of people they picked?
I mean, my reaction is what I wrote. Where is my guy Sundar Pitch AI? But yeah, okay, they put their demis from DeepMind, so I guess that's fine. We've got Zuck, Lisa Su, Elon, Jensen. You see Elon not next to Sam Altman. That was they put Jensen in the middle of the two. Then you have demis. Then you have Anthropic guy, and who's the last? Who's the last person?
The lady, right? I have no idea who's that lady. I don't know. I know Lisa Su. I don't know who the other lady is. Let us know in the chat if you know. But I guess they couldn't pick someone to be the Person of the Year, so they just picked all the AI people, and they left out a bunch. I mean, Sundar's stock is up 70%. He's beating everyone else this year. They don't have Alex Karp. I didn't expect Alex Karp, but still, like, he's pretty important when it comes to AI. Fei, she's a top AI researcher. All right. Well, that is Time's Person of the Year. AI architects is what we got. That's it. All right, folks. I think that is it for us. I'll be live tomorrow for Broadcom. Maybe Neil will join me, but if not, we'll still be discussing Broadcom. I think that's probably going to be a much bigger one than Oracle and Adobe, to be honest. Adobe after hours, flat. Oracle getting hit. I wouldn't be surprised if Oracle rebounds tomorrow. I mean, at the end of the day, it still is a pretty large company, so I could see people buying the dip, but that call was just not the most exciting. Adobe right there, up 0.19%. Lulu and Broadcom are tomorrow, so those are the big ones. One big retailer, Broadcom, hit all-time highs. So they closed at all-time highs at 412, $1.95 trillion company. I think they're going to have a pretty monster earnings. It's just that one is definitely, you could argue, price for perfection. So we're going to have to see what numbers they can put up as well.
I think we have Costco as well tomorrow for
oh yes, Costco as well.
Bigger economic maybe data type of thing. It's going to be interesting because now we had like a dovish Jerome Powell, and now we have Oracle maybe ruining the party a little bit. So we'll see how we go, how we open tomorrow or close, and then next week with CPI reports is next week, right? We're not getting PPI, we're getting CPI next week for now, unless it gets canceled as well.
Yeah, and there is Neil's Twitter. You guys can follow him there as well. Now, again, in terms of J-Powell, like, he was pretty damn dovish. I don't think Oracle, and I know some people in the chat said Oracle ruined the Santa Claus rally. I wouldn't go that far. I think J-Powell really set us up to have a good run towards the end of the year. Seasonally, we're on the right side. of the year in terms of rally. We needed the cut. We got the cut. We needed a dovish cut. We got a dovish cut. Maybe it turns out to be a sell the news tomorrow, but J Powell did everything he could possibly do. Hopefully Hawk Tan saves us tomorrow. But J Powell, like, no one can be mad at Powell. No one. I mean, he said everything you wanted to say. I mean, he basically said the tariffs are a one-time issue and it shouldn't be affecting inflation. The whole concern over the past couple of months or past couple of weeks was inflation is going to matter more than the labor market. Clearly, he said the labor market matters more than inflation and even downplayed the problem of inflation. Now, maybe it's because he wants to secure his legacy as the guy that took inflation down from 10% to 2%, which, to be fair, he did. I mean, he's done a phenomenal job over the past couple of years, even if he was a little late. But it's not like inflation seems like it's that big of a concern. So I think from a macro perspective, you've got the market in a place where it can get to all-time highs. Oracle, it'll have some issues maybe tomorrow and next week in terms of how the market's thinking about AI, but I think that stuff gets resolved relatively quickly. The next catalyst, I don't know. Neil, I guess that's my last question to you. What do you think the next catalyst is for the rest of December? Or do you think it's just seasonal to potentially get towards end of year chasing, I guess, to get to end of year highs potentially?
Yeah, probably. I mean, if the CPI report comes in much better than feared, I guess the whole inflation story thing is going to help the market close out a bit higher because we are already quite high. But a good CPI print could help us. Hawk Tan could not help us tomorrow because Hawk Tan is basically like the anti-NVIDIA story. So a good Hawk Tan Broadcom report tomorrow is going to counter the whole GPU thing. So you might not want to have that because he's in the Google camp of TPUs and ASICs and all of that. So we'll see. But yeah, a good CPI report, I guess, could help us out. But I mean, we just had the earnings season. Most companies beat earnings quite comfortably. Most had good guidance as well. So it seems like the companies that we follow and maybe even own are doing well. And it seems like the economy is doing better than feared. And we got a rate cut. We got a dovish Powell. So what more can I ask for? Probably for the market to continue to go up. But okay, maybe not being that greedy. But you asked the question, so I answer. I hope we do end the year even higher. But we'll see.
All right, that's it for us. Thank you, everybody, for being here. 4-hour stream. We had Powell, we had Oracle, we had Adobe. I'll be live for the market open tomorrow, and then we will have what's the other one? Broadcom, which will be a big one. And yeah, Neil, you do have a point. I mean, if Broadcom does crush it, technically, it's bearish NVIDIA, but hopefully it still helps the broader market, given Broadcom is up there in terms of weightings for the S&P. All right. Thank you, everybody. Appreciate it. We'll see you guys tomorrow, and thank you for joining. Bye, everybody.